Thank you for coming for a one-day workshop on FEMA. It's my pleasure to welcome Sridhar sir to occupy the dais. I request all to please rise for our CM motto song.
सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामुषो पुरुषो निर्विमानः निर्विमानः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तस्मिन् लोकः शितः सर्वे तदूनात्यतीतश्च नात्यतीतश्च एतद्द्वैत 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 एतद्द्वैत.
Please be seated. Those who are interested for woofer registration, the PO is in the front desk and the woofer video will be paid for your consent.
Arthashastram, Dharmashastram cha, meaning economic principles, earth, and ethical considerations, dharma, which are central to the work of accountants. The entire world is deliberating about the impact of climate change coupled with disruptions of artificial intelligence. India has given philosophy of Vasudhaiva Kutumbakam to the world and successfully hosted G20 summit on this theme and also launched Global Biofuels Alliance. The accounting profession also has an enormous responsibility to guide the work where accountability meets innovation so that vision can be converted into solution. The Institute of Chartered Accountants of India, being the world's largest accounting body after the successful hosting of WCOA 2022 and GLOBAC, proudly presents before the World Forum of Accountants 2025. Where accountability meets innovation for a sustainable planet. The world's brightest minds will exchange insights, explore emerging trends, and unlock the possibilities for the profession, where foundation will be laid to shape the vision for the future of accounting profession. Hosted at Yashobhoomi, the largest convention and exhibition center in the heart of India's capital, New Delhi, inaugurated by the Honorable Prime Minister Shri Narendra Modi, is all set to host the congregation of accountants from around the world. And while you're here, experience the vibrant culture and heritage of New Delhi, a city where history meets modernity, offering unforgettable memories.
World Forum of Accountants, an experience of 3 days, insightful discussion, groundbreaking innovations, and unparalleled networking opportunities.
With immense pride, we invite you to WOFA 2025, taking place, happening from January 31st to February 2nd, 2025 at the magnificent Yashobhoomi, New Delhi. Experience 3 days of insightful discussions, groundbreaking innovations, and unparalleled networking opportunities. World Forum of Accountants 2025 is where you need to be, where accountability meets innovation, AI for a sustainable planet. Join us at WOFA 2025 from January 31st to February 2nd, 2025 at Yashobhoomi, New Delhi. For more details, visit wofa.icai.org.
It's my pleasure to introduce T.R. Sridhar, sir, who is fondly known as a FEMA TPS, is a commerce graduate and fellow member of the ICS, Company Secretary of India, in full-time practice since 2001 as a sole proprietor, providing service to domestic and international clients under company law and foreign exchange. He has been speaker in various chapters of the ICS of India and ICAI on FEMA. He has been invited by bank to handle their Pan-India workshop on practical aspect of FEMA and also to share his knowledge and experience to their clients. He specializes in advising on capital structuring, compliance, compounding and matter related to enforcement directorate to his domestic and overseas client. He closely works with clients from US, UK, Japan, Korea, Denmark, Zealand, Hong Kong, who have retained his service for his knowledge and expertise in the specialized field of FEMA. Thank you for your presence, sir. I request CA Chakravarti sir to present memo to our speaker. And over to the speaker.
Good morning, everybody. I thank the Institute of Chartered Accountants of India, the SIRC, for organizing this program and having me here. My gratitude to them. I thank every person who is present here to attend this program, taking time off to be here. Thank you so much. The time given to me is from now to probably 1 o'clock, where I'll be dealing with, or I'll be sharing my experiences on Foreign Exchange Management Act with specific reference to liberalized remittance schemes and the overseas direct investment. I have a small request. Where I am not clear, where I am not able to communicate, I request you to stop me, or where you have some questions, you can stop me then and there, so that I will try and answer those questions. Where I may not have answers for all your questions, because the kind of doubts that people have in ODI is so wide. The permutation combination, especially in the practical aspects, are so vast, deep and wide. So I may not be able to give a ready-made answer for everything, but I will try. I will share, I'll also give you my contact numbers are here. I'll also give you my email ID. Probably you can write to me. I'm available on a click, walk and talk. That is, you can, by clicking your mouse, you can write a mail to me. I will clarify your doubts. I live in Chennai, in Ashok Nagar. You can walk into my office. And my numbers are here. You can talk to me anytime. So with this in background, and with your permission, let me start. The first, from now on till probably 11:30, 11:45, I would like to deal with liberalized remittance scheme, what is called as LRS. LRS dates back to 2004. Let us start with, it's a platform or it's a mode given by the government, central government, for resident individuals to send money abroad for various purposes. In view of the comfortable foreign exchange reserves, LRS was introduced on 4th February 2004. It has been actually liberal. The kind of money that people are permitted to send out of India started with $25,000 and today it is much higher, $250,000. It's like this. When I have enough money or when I don't have money, probably I'll have a breakfast in a Kayedi Bhavan or a lunch in a B-grade hotel. But as I grow, as I earn more and more, I would prefer to have my lunch in a different, breakfast in a different hotel or a 5-star hotel for my lunch, breakfast and dinner. So as the reserves are increasing, government thought that the opportunities will have to be given so that people make investments outside India. It was introduced as a measure to facilitate resident individuals to remit funds abroad for permitted current account and capital account transactions. That means this is available, the liberalized remittance scheme or LRS is available only for resident individuals for the purpose of making payment outside India for capital account and current account transactions only. Right? This is where actually it has been very liberal. It started off with on 4th February 2004, and where the dollar price was probably 45 rupees at that point of time, and we were permitted to send 11,25,000. This $25,000 at 45 rupees per dollar approximately works out to $11,25,000, 25,000 rupees at that point of time. In 2006, actually you may see that it's been getting doubled. $25,000 became $50,000. $50,000 became $1 lakh. $1 lakh became 2 lakhs. And for reasons it came down. Again it has gone back to $2,50,000. That means as I told you, when I have more money, the way I live or the way I spend could be more different completely. Similarly, as the reserves started increasing, government of India thought that people should also be, like we are receiving a foreign direct investment, government thought that people should be allowed to make investment outside India. Hence, they brought in the liberalized remittance scheme. So, right from 2004, it started off with $25,000 and progressively increasing. And today it is $2,50,000. That is, today means it's from 2014 till date. It is $2,50,000, which boils down to approximately or slightly more than 2 crores of Indian rupees. You can make investment. Let me go through how the monies can be sent. What are the purposes for which it can be sent? Let's look into it. Applicability applies only to resident individuals. For somebody to send money abroad through LRS scheme, he has to be a resident individual. Scheme applies to minors also. That means minor cannot send. Minor can do it through their guardian or parents. So minor is also entitled for the LRS. Consolidation of remittance of family members. That means, assuming my son lives abroad or studies abroad, then my wife, my daughter and myself can combine the LRS and send it to one person. So the company, I can consolidate, and each one of them is entitled for $2,50,000 for every financial year. So I will be entitled for $2,50,000 to send it to my son. My wife will be entitled to send $2,50,000 to my son, and my daughter will also be entitled to send it to her brother. So in a year, every family member can send. It is not the question of who is receiving it, it's a question of who is sending it and how much can be sent. Bank cannot finance for the facility. That means you cannot borrow money and send it outside. The purposes for which LRS is allowed is, one of the things is you can also make investments. So probably the lawmakers have thought that you cannot borrow money and send it abroad. And the money can be used for the capital account and current account transactions. Right? So the applicability, it applies only to resident individuals. The scheme is applicable to minors also, consolidation is possible, borrowed money cannot be sent and it can be used for capital and current account transactions. This is how the LRS works. Can I move on?
Consolidation, you say, whether from one account we can send all this money.
Sir,
4 members are in the family, whether I can send the, suppose.
Sir, banks do not permit that, sir. Banks will want that to be sent from 4 different accounts. The person can be, the recipient can be the same. It has to go through 4 different accounts so that, no, that's how it is normally done.
Joint account also they cannot send them.
Joint account, the first named person can send, sir.
First person.
See, again, see, as I told you, this is very, very operational thing. Some banks may allow it, some banks may not allow. If it is joint account, I think only one person can send it, not this. Maybe they want you to open a separate account. Of course, you also have the relationship issue. You should have 1 year of relationship with the bank. That is also there.
There is a cap also on the 250,000. So up to 250,000 they can send. Beyond that, it has to be only from second account.
No, up to $250,000 you can send it, which is around 2 crores.
Which is around 2 crores. So, but
2 crores.
beyond 2 lakh, then it has to be necessarily somebody else. I mean, your wife or brother.
Yeah. So every individual has got a eligibility to send up to $250,000 from his or her account in every financial year.
Sir, one more doubt. Banks not to finance for the facility, no? Suppose he took an education loan for his son. So from that money he may be sent to abroad for the facilitation of education. Suppose my son is in abroad. So I go borrow money from the bank for education purpose.
Sir, to my knowledge, such borrowings does not come into the parent's account. It goes to the university directly.
Okay.
In fact, I have borrowed like that. So the bankers say that they will, sir, they are not very sure whether you are going to send it or not, sir. When I borrowed few lakhs for my son's education, they said they will send it directly to the university. Because when they give it to me, no, they don't have a guarantee whether I'm going to actually send it or spend it off here in India. Diversion will be there. So in such cases, they send it directly. So what you can probably send for the living expenses, other things you can send. Buying property, investment, those things you can send. So borrowing, you cannot do it.
Actually what happened, my son is studying abroad, so I have no sources to send money. Suppose I borrow as a personal capacity from the bank, then I take it into my account as a term loan, then I send it back to
Sir,
my son.
correct.
Yeah.
Sir, normally what happens is, for an LRS you must have a relationship, existing relationship. So they will probably ask you for the balance sheet, past sheet for the last 6 months, 1 year or so. Check with that how the monies came. Suddenly it's a huge credit that they may ask you to give a declaration that it is not a borrowed money or something like that. So they may ask you for a declaration. So you will have to give a declaration saying that whether it is borrowed money or not borrowed money. Based on that they will send you.
Sir,
Yes, gentlemen.
it is $250,000 or $250,000 because specifically my instrument was rejected because the banker mentioned $250,000. It was rejected by the foreign banks. They asked us to send us $250,000. It's 250,000 you said. Lakhs is not there in dollars. It's only $250,000.
No, it is the law is very settled, sir. It is $250,000.
No, but the foreign banks, they said we don't recognize lakhs. If words and figures, the words, 2 lakh, the banker has written $250,000. The foreign bank said it returned. We had to again resend twice fast. The 4 year and
Oh, so it is not a question of amount involved. It is a question of how do you write the check or how do you transfer it.
$250,000, not 2 lakh. They write the same thing in India also.
Yeah. See, off late, sir.
Not the same.
Sir, personally, I can tell you, maybe people born in 60s and 70s, we are only governed by the British thing where we talk about 100,000, 10,000. Today, people talk about millions, right? So you can say it is $250,000. I will say it is $250,000.
You can see internally.
Okay. 4 ஆனா சொன்னாலும் ஒன்று தான், 75 பைசா சொன்னாலும் ஒன்று தான். எங்க பாட்டி 4 அணா தான் சொல்லுவாங்க. 4 அணா. Maybe senior citizens will appreciate that. Okay, so yeah, because the overseas bank did not understand this. Absolutely, sir. I see a lot of the remittance advice from there where they put 2.50.000. We use comma, they use dot. Full stop. End of the day, the words and figures are the same. Things are changing. Right? $250,000. Because they don't understand 2 lakhs, they don't understand, probably they don't understand lakhs. What else that we are talking about? I think all of you understand Tamil, right?
Yes.
There is no. What else that doesn't solve no. But doesn't the concept kadayadu. It's a multiples of 10. Or gross abino 12 into 12, which is not there now. Things are changing. So on the case, probably your overseas banker may not accept, would not have thought about this.
Sir, I have
Sir.
got one question.
Sit down, sir. Please, sir.
No problem. Apply to only resident individuals. I am an NRI. I have got in my NRO account 50 lakh of rupees. Now I gift it to my brother. Can my brother as a resident kindly transfer it?
You are a NRI residing in India. You are an NRO.
NRI located outside India.
Okay.
I am not in India, I am in USA. I have got in my NRO account 50 lakh of rupees.
Okay.
I want to transfer it to my account in USA. Now, LRS scheme is applicable only for resident individuals.
Sir, there you have a different scheme altogether, which is called a 1 million scheme. So first you will have to transfer it from your NRO to NRE, which may be a
15
charge.
CA, 15 CB.
Pardon me?
15 CA and 15 CB may be required. Form number 15 CA.
Yeah.
15 CB
Sir,
will be required.
sir, on a lighter side, on this hall filled with chartered accountants, I am not competent to talk about 15 CA or CB.
Okay, understand.
I don't want to take.
overcome the situation.
Yeah, see, maybe 15 CA CB bankers would require,
Require.
but it is your transfer of your money from your NRO account to your NRE account,
NRE account, then I
and
can
from
transfer
there transfer it out of India through a 1 million scheme.
1 million scheme.
But 15 CA CB is again from your account to your account is getting transferred. I don't understand. I don't know tax laws, right? But I don't understand why a banker should insist, because even I have couple of bank accounts. When I transfer,
I clarify this to the extent that I understand. 15 CA, 15 CB maintaining an NRO account is to make sure that the NRO account is maintained for all the income that is getting generated
Currently.
in India, which is getting into your NRO account. So the tax authorities, as so far as they are concerned, they are only bothered whether the tax return has been filed and adequate taxes has been paid. Once that is paid, then the person who has to remit the funds gives the form 15AB, and the chartered accountant certifies that as a form 15AC.
Correct.
And post that, only the income is, the limit of the income is $1 million, but the gift that he wants to give to his brother doesn't come under this provisions at all, to my understanding, to my knowledge.
sir, first is his brother, whether he is a resident in India or resident outside India, because
Resident in India.
the donor is outside India.
Donor is outside India.
The donee is in India. It is he need not have to even transfer.
Correct.
Because from a donor is outside India having an NRO account, and the donee is in India, NRO account to a resident individual should not be a problem. So without a 15 CACB, it could be it can be transferred, full stop.
Correct. See, NRO to NRE is only the challenge. NRO to resident Indian, if
Should not be a challenge,
and that too when you are giving it as a gift.
I stop it with that because I am not very sure about 15 CACB. So from NRO account as a gift to your brother in a rupee denominated rupee in rupee, it should not be a problem. That's what is.
Transferring it to my account?
Sir, you can transfer it to your account, sir. NRE to NRO to NRE account is possible, subject to the banker being satisfied.
My brother, they're transferring to my account.
Your brother in India can transfer the money to NRO account.
No, not NRO account. He's transferring directly to my account in USA.
Then the first question is whether it is a gift or a lending.
It's a gift.
Yeah, gift, I think that we will discuss separately, sir, because it does not come under, he can do it under LRS. He can do it under LRS to a relative. Okay, sir. Sir, what they are trying to say is you cannot borrow money and do it. Very simple. Bank cannot fund it. It can be non-banking company. It can be it could be a banking company, whatever. The idea is you cannot borrow and send money abroad. That's the whole thing. And you cannot use it for LRS. Very simple. Okay. With your permission, we will move on, sir. Next is the capital account transaction. Capital account transaction up to $250,000. Opening a foreign currency account abroad.
Non-resident Indian, but not for non-resident.
Loans including loans in INR to NRI.
But not non-resident.
Non-resident Indian. Right? It can be, sir, if it is going to give it in India, it becomes a rupee transaction. Right? My brother is abroad. He has got an NRO account. He is going to give money in India. Then it is only a rupee transaction. Why LRS? If somebody is abroad, a resident is going to send money, it is going to be a cross border. Then this question of $50,000 comes into play. Current account, private visits abroad. Many of us go on a holiday. We take, of course, travel checks are no more in vogue, but we send money, we carry currencies, we carry whatever. Look, we carry those debit cards in American dollars or Singapore dollars or Malaysian dollars. Those come under the LRS scheme, where it's a private visits abroad. Gift or donations up to $250,000 is permitted. Going abroad on employment. That means you can use this money to transfer your goods. You go settling down there. All those things. This current account, this LRS can be used. Immigration, maintenance of relatives abroad. That means you send money. My son was in UK for a long time. I had to send him month on month. I had to send him money. Probably this is one of the LRS, through LRS I was sending him. Right, I was sending him. What I was sending was paltry sum, maybe a couple of lakhs I was sending. But still, I was maintaining my family of my son abroad. So that is one use. Business trips. We travel abroad and come back on business. Then medical treatment abroad. See, the exception here is in case of medical treatment, where the expenditure is going to be more than $250,000. With the AD bank may apply to RBI and take special permission. But there is a provision. But I don't think how many banks are doing it. For medical treatment, they permit in exceptional cases. Otherwise, $250,000 is the cap. Studies abroad in foreign universities. If somebody is going to study abroad, we can send money to the student from here. The parents can send money here. But where it is a loan from a bank or from educational loan, then the lender will send it directly to the university. The money normally is not given to us. That's what happened in my case also. The lender sent the money directly to the university, not even to the student. The living expenses was borne by me.
So both, you can use $2 for current account or $2 for
$250 is one.
total cap.
$250,000 is one. அது எதுக்குனா செலவு பண்ணுங்க. Per annum, per financial year, per person. So நான் வந்து இன்வெஸ்ட் பண்றது யூஸ் பண்ணலாம். I can invest in securities. I can buy property. I can send it for my son's education.
Overall cap is 2.
That's all. You can bifurcate and use it for anything. Prohibited transaction. See the speciality of this thing in the FEMA is what is not expressly permitted is prohibited. If the law is permitting you, you can do it. If it is not permitting us, it is prohibited. That means you cannot circumvent law. Maybe I don't know about income tax, but under Companies Act, we are trying to circumvent law, we see how it can be done. those things are not permitted under the Foreign Exchange Management Act. So what is permitted alone can be done. What is not permitted, either it can never be done, or it can be done with the prior approval of Reserve Bank of India. Right? So capital account remittances to countries identified as Financial Action Task Force as non-cooperative. I think I'm not very sure how many countries are there. I don't think there are any countries like this. But you cannot send money to
North Korea.
North Korea. Maybe, there are few countries where I'm not very sure about it. But you cannot send monies to them where they are not cooperative or where it is not a FATF compliance countries. So what is prohibited, that's it. You cannot, even if you make an application to Reserve Bank of India, you may not get an approval for those transactions. Can I move on? Any questions? RBI does not prescribe the document to be verified. That means it is left to the hands of the authorized dealer to ask for any document. Maybe they can ask you for the last 3 years bank statement. Of course, they may be having it, but still they may ask you for this. They ask you, definitely they'll ask you for, they can ask you for any document. If I go tell my banker, my son is abroad and he's studying in London, maybe he will ask for bona fides of my son. He may ask to check whether he is my son to send money. So RBI has not prescribed any document because it has left it to the AD banks to check all these things. That, see, by and large I find the Reserve Bank of India has been decentralizing. Originally, the FCGPR approvals and FCTRS approvals were with Reserve Bank of India when it was physical. People who have handled prior to 2016-15 these capital account transactions will appreciate this. We used to go and give the FCGPR or FCTRS on a capital account transaction to the AD bank in duplicate. AD used to check it and send it to RBI, and RBI will then take it on record or give their comments. Authorized dealer. Any banker, you call it as a. Okay. So today, from physical we have moved on to EBIS. From EBIS they had some difficulty. From EBIS we have moved on to the firm's portal or flag portal or whatever. When you go to the firm's portal, I think many of the times it is within the scheduled, within the prescribed time period, and all the documents are there. The AD bank itself have been authorized to approve the transaction. Where there is LSF, then it is referred to the AD, Reserve Bank of India for calculation of the LSF. So coming back to the point, RBI has not prescribed any document. So that means it has decentralized and left it to the option of the AD bank to check the credentials of the. See, unless you have a relationship with the bank, you will not be able to send any money. So by the time you establish a relationship, you would have given all the documents. So in addition to it, they may ask for more documents to satisfy themselves about the genuinity of the transaction. Form A2 for purchase of foreign exchange. Form A2, anything wherever you want to send money abroad, Form A2 is a base document where you need to fill it up and give it. Copy of his PAN, his or her PAN card, maybe it has to be self-attested PAN copy. Sir, any questions? Sorry. Relationship with the AD bank for 1 year for capital account transaction. That means you should have had a relationship for 1 year. Today I can't open a bank account with, an account with any bank. Maybe a nationalized bank or a new generation bank or a private bank, and ask them to send money. Bankers insist on a 1 year relationship for sending. Maybe, I don't know, there may be bankers who are compromising, but by and large bankers are very clear, and unless you have a 1 year relationship, they don't allow you to send it. Can I move on, sir? Sir, by and large, this is the LRS whole thing, sir. Not a big deal. Because LRS, no, there's no big documentation. You don't have any compounding process. You don't have any late submission. No? The purposes for which LRS can be used is very clear. The amount is very clear. The amount that can be sent abroad is very clear. And it is left to the AD bank. AD bank can ask for any documentation, satisfy themselves about the genuinity of the transaction and send it abroad. Very simple. Can we move on, sir? Any questions so far? Can we go to ODI or can we take a break and then come back? We go to ODI? Where do we start? Overseas Investment Rules 22 issued by the central government. I mean, when somebody wants to make a overseas direct investment, maybe a practicing chartered, anybody for that matter, be it a corporate entity or a chartered accountant or a company secretary in practice, anybody, where do they start? These are three things that they'll have to go through. The Overseas Investment Rules 2022 issued by the central government, Overseas Investment Regulations, Overseas Investment Directions issued by Reserve Bank of India. All these things were effective from 22nd August 2022. Before that, we had the Master Directions on joint venture or wholly owned subsidiaries abroad. That has been done away with, and now you have these three regulations. That means you have the rules given by the central government, the regulations given by Reserve Bank of India, and the directions by Reserve Bank of India. So all the three you'll have to go through to understand the ODI concept as a whole. Here again, I will tell you what is not expressly permitted is prohibited. So if you cannot, these three line items, the rules, regulations and directions, if they do not permit you to do anything, you cannot do it at all. If it is prohibited sector, yes, it is prohibited. Even, no, the governor of Reserve Bank of India may not be able to give you permission. It is prohibited, that's it. In certain cases, you can make an application and get the special approval in certain cases wherever it is. The basic thing is reporting. So who can applicability, all investment transactions done by investor in India, whether individual or non-individual, in an overseas entity. So all transactions, so it applies to all the transactions where you want to make an investment outside India, be it an individual or be it a corporate entity. It has to go through the AD bank and it applies. This ODI regulations will apply.
Individuals mentioned applicability.
All investment transactions done by investor in India, right? Companies, what is corporate, limited liability partnership, registered firm. The commonalities, all these things are registered with some enactment or the other. If it is individual, you come under LRS. You will have to comply with this thing, but you go under the LRS. The commonality is this: companies, it's registered under the Companies Act. Be it a public company or a private company. What is corporate? Could be a trust or a society, subject to their bylaws. And you have the limited liability partnership. Again, it is registered on an enactment. And the last you have is registered partnership form. That means unregistered partnership cannot do this. The partners of the unregistered partnership firm can do it in their personal capacity, where they invoke LRS. If it is a partnership firm, unregistered, they cannot do it. Only the partners can do it in their capacity. Registered partnership can avail of the ODI facility.
Sir, the earlier slide is not the earlier one, the first slide which you showed. See here, what I am understanding is overseas investment rules, overseas investment regulations and overseas investment directions. That means as an Indian, I am doing an investment abroad. That is the purpose of
Purpose, yes.
No, let's go to the next one. But here only we are talking about investor in India. That means a foreign NRI or a foreign body is doing an investment in India.
No, that is the FDI. That is FDI. What we are talking, see, when money is sent abroad,
I am sending money abroad.
Yes, I am a resident. You are a resident individual. You want to send invest money abroad, or you are a private limited company or a public company, then you are governed by these three regulations.
Yeah.
So you need to understand the rules, regulations and directions for you to make a overseas investment. Right? Next slide talks about all investment transactions done by investor in India to a overseas body. That means ODI. If you want to do an investment abroad,
If I want to do an investment abroad,
then apart from those rules, regulations and directions, then it is reporting to
India
expand.
is doing an investment
From India, it is an outbound investment.
outbound.
Sir, I like to make one suggestion. Instead of buy an investor in India, if you put it by an Indian investor, that will be more clarification.
Yeah, investor India means it includes
Yeah.
not only individuals, it
Yeah,
also
sir.
includes the body companies, bodies, corporate, limited liability, everything. So that is the reason I use the word, because it is an individual, then it is governed by LRS completely different. Now we are talking about an ODI for non-individuals, which is a company, which is a private or public company, which is registered under the Companies Act, bodies corporate, a registered trust society, etc., or a limited liability partnership. That means there is some law that is governing these four items. There is some regulator. Only when it is registered with some thing, you are permitted to use this and send the money up. We can make an overseas investment. That overseas, you can have a financial commitment outside India. Originally, all these three regulations, we had only one simple thing, which is joint venture or wholly owned subsidiaries has been done away with. It used to be master directions on joint venture or wholly owned subsidiaries. Now that has been removed and all these things have been, it is more clear. We have the rules, regulations and the directions, which is very clear.
Sir, for LRS, this is what it means. For all these entities, what is the...
I'll come to it, sir. I'll come to it. There are limits for that. There are limits for that where you are going to invest on a
Current
company.
account transactions.
Pardon?
Current account transactions.
Yes, sir. When see on a current account transaction where you go to buy and sell, trade, you don't have any use. It is only on capital account transaction. Because they cannot fix a limit on my current account transaction. நான் எவ்வளவு வாங்கணும், எவ்வளவு எக்ஸ்போர்ட் பண்ணணும், எவ்வளவு இம்போர்ட் பண்ணணும், யார் சொல்றது? I have the capability to export, I have the capability to import, I keep doing it.
But there is an overall limit.
Limit கிடையாது. In current account limit கிடையாது. For corporate, because they are going to, that's the purpose of that company is only to do that. See, ஒரு company Indian leave alone the FEMA part. India இந்த company இவ்வளவுதான் turn over பண்ண முடியுது இருக்கா? It can be my family company with me and my wife as the directors and shareholders. I can do some 25, any $1 trillion transactions, right? No one can stop me. So similarly, in the current account transaction, even if it is cross-border, you can keep importing, you can keep exporting. That is completely governed by your master directions on import and export of goods and services, import and export of goods and services, and export of goods and services. Yes, ma'am.
I recently got an opportunity to do an ODI, sir.
Yeah.
So basically, there are two individuals who had invested in a German company.
One second, sir. Mic only.
Hello.
Yeah.
So basically, there are two individuals who are partners, who are going to be partners in a German company which is incorporated outside Germany.
Yeah.
So the process is, the company is already incorporated in Germany.
Okay.
They have to bring the initial capital.
Correct.
So we approached the bankers. The bankers asked us to fill few forms for ODI. So as there are two investors, we filled the forms.
Two Form FCs.
Two Form FCs in the respective banks. One Bank of Baroda and the other one HDFC. But later we came to know that there can only be one AD banker, even though the investors are different, but the investing company is one. They need only one AD banker. So all the accounts need to be opened for both the individuals in one bank, and they need to generate some code. So why can't this be done in LRS, sir? Because those who are investing are only individuals, where it can be done through LRS. Why did the bankers ask us to open the bank account for both the individuals in one bank and create a
I'll come to it, though I have slides for that, but let me answer your question specifically. When I make an investment, I'll give you another example. Suppose all of us want to go out of this, or people want to come into it. There's only one gate, one door open. Why? Because somebody wants to know how many people are going inside. To have a count, to have a control. They can't keep on sending people more than what it can accommodate. So there's only one door to keep a control of how many people are going in. Correct? So in an ODI, in a cross-border transaction, when I want to invest abroad, every investment or every foreign entity, when the investment is happening, there is something called as UIN that is generated. There is only one UIN for every company, every foreign company. Suppose I invest $200,000 today, there is a UIN generated. That same UIN, using the same UIN, my wife will also have to listen. Right? That is only when it is routed through one bank, they will have a control. I tell you, typical case, I tell you, there was a ODI transaction, there was a ODI happened long back. The resident individual wanted to sell his shareholding to a company not in Tamil Nadu, in some other place. They had to open a bank account in the same bank and send it to them, because to have control, they cannot change the AD bank or the branch without the prior approval of Reserve Bank of India. So when it is simple, why only one door? Because to have control. So when I want to send money, suppose I have one foreign German company, and from all these 25, 29, 30 states, people keep sending money. What is the control people will have? End of the day, it is the exchange reserves that is going out, and we are not very sure what is going to come back. Right? Because when I invest money, look at it from India perspective. When India is investing, India will expect something. When you and I invest money, some few thousand, couple of lakhs in a company, we look at how it is growing, whether it is safe. That's why they attack balance sheets first. Then whether it has grown, whether there is any return. Right? When you and I, small people like, I as a small individual investing 2 lakhs, will what?
So my understanding is, if I am an individual who wants to invest in a company, I can put through LRS. But we have few partners put together who want to invest in one entity, we may have to do it through ODI form MCL.
No. It is individuals. If you are multiple, even if it is 10 individuals putting from the same family or from the same company or whatever.
Okay.
It is, if they are, as long as they are individuals, it is only LRS.
But we need to fill form FC.
For each one of them, form FC will have to be filled up. When the first investment is happening, you will get the UIN number, so the investment will happen. Subsequently, these people can use the same UIN number and route it to the same bank. Maybe because of the core banking.
One person is doing in Chennai, one person is doing in Mumbai.
Sir, that's exactly, I had a problem, sir. One of my clients had sold their investment in an American company to somebody else, not in Tamil Nadu, but somebody else. They were asked to open a bank account here and send it from here. It is practical, because control is more important than convenience.
Sir, why not LEA can be used as a controlling factor?
Sir, LEA can be used, cannot be used. It's very subjective.
Because any number of bankers, any number of investors can invest in one particular entity, in one particular country.
Sir,
but the key field, let it be LEA.
Sir, it is very debatable, sir. Point number one. One second, sir. Point number two, it is only a point of concern, circle of concern. It is not a circle of influence. We cannot go change it.
Because LEA code we can grasp easily.
Yes, you are right. I take your point, sir.
Someone transferred the funds from Mumbai. Then how does it know that the controlling branch is in Chennai?
Sir, when I transfer my investment abroad to somebody in Mumbai, right? I will have to file a form called Form FC Part G, which is for disinvestment. That is, I am disinvesting, and somebody else is buying. That somebody else is buying will have to give Form FC for making his investment. But there, UIN will not be generated because they already have UIN. There is a project profile is already there. It is sheer control, sir. There won't make an inconvenience for the. He has to open a bank account. Maybe the core banking, any bankers will. Core banking may help, but I am not sure about it. But end of the day, the law is very clear. that everything has to be, for every investment there is only one UI. Right? There is only one project profile. America or company invest and the company or the American company or UI. Anka evlo guarantee kuduthirukanga, anga evlo invest pannirukanga, yaarla invest pannirukanga. This is how they have control. End of the day, it's hard and reserve that is going out. So they want to have control.
Sir, I am having only one banker from 2001. 2014 we had a branch. We sent somebody. All same bank. But with no UAE was the now suddenly these people are asking give me UAE.
Sir, this is the biggest problem with this thing, sir. Especially on liberalization and on getting automated online filing. We have this, especially from people who have been operating from 2000 prior to 2016, during 16 to 18 and 18 and onwards. So people, the sheer lack of, I'm sorry to tell you that, by and large, from the client perspective, what they feel is, I have given it to the bank would take it care. Now reporting funded. But actually it is not so. You will have to ensure. See, when you have made an investment, the banker should have advised you about the UIN. Banker should have advised you about UIN. Unless you get a UIN, you cannot make an investment.
But tell me one thing. See, today I am doing an investment in US. Let's say for $1 lakh. Tomorrow I am doing an investment in another company for 1 lakh euros. Probably equivalent to 2,50,000. It comes well within that limit, but I am doing it in a different continent, different project altogether. So the first time I do an investment, I do it, let's say, through SDI. Second time I want to do it through HDFC.
That is permitted.
That's permitted.
That is permitted. For every company I invest, I have one banker. Banker X for investment in America, it happens. I can choose banker Y for investment in Australia or Singapore. So every investment that is happening, for every investee company, it is one UIN. It is not the person who is investing. Just give me 1 minute. Yes, sir.
What is the remedy or the repercussions?
Okay, in fact, I wanted to deal this at the end. The cut-off date is 22nd August 22. Prior to that, if you have not complied, better comply it and go through LRS process before 25th August 2025. This LRS is open only for 3 years. After 3 years, that is with the introduction of the ODI regulations, directions and rules on 22nd August 22. The RBI was said it is going to be very liberal on regularizing. That means they have given us a 3-year window for regularization. That is, you come under LRS. You don't have to go through the rigmarole of compounding. So before 25th August 2025, if you can regularize them, first you will have to comply with your administrative procedures. Once the administrative procedure is completed, and then you can apply for a LSN. I'm sorry, LSN. The law is the same. You will have to comply first. The administrative procedure will have to be compliant. With the bank. You will have to get the UIN now. You will have to ask for the project profile. You will have to establish when all the investments are. If you practical what the banker will say, sir, when all you have made the investments, sir, can you give me? In fact, he will have everything. No, sir, we don't have everything, sir. We have bank account. Our server has been packed up. Then they'll give you 1 million. With due respect to the bankers. If you are talking about anything more than 10-12 years, then there could be a challenge.
It's 2014.
So 2014 probably they may have. You can figure out when all the investment has happened, and you will have to first get those share certificates for the investments. You will have to prove that investment happened. Right? I send money from here. I'm saying, oh, I'm going to invest in America, but I don't. Or I invest in America, but actually investment is not happening. The shares are not allowed.
Money is coming through the account. Foreign returns are coming through.
That it is not enough. You will have, if you are honest. You will have to appear to be honest. I'm sorry, it's not enough if you are appearing to be honest. You will have to be honest. Okay, you will have to be very clear. So it is onus is on you. So you, sir, my humble request, suggestion is, please, before August 2025, see if you can regularize everything and do away with your LRS. Sorry, LSF, pay LSF and project. Because one receipt of non-receipt of share certificate is a non-compliance. Not getting UIN is a non-compliance. Not getting UIN and sending money could be an issue. Non-filing of APR could be an issue. So 14 to 24, you may have various non-compliances for each of the years. And adukella set compounding ponina investment cost ஜாஸ்தி ஆயிடும். அதனால better LSF இருக்கும்போதே நீங்க வந்து close பண்ணுங்க. And you still have time. We have at least another 6-7 months to go.
It's not a brand insurance. Not a insurance.
Now then it's a completely different ballgame. If it is a branch of your company, it's a different ballgame. Right? Yes, sir.
So there was a point you were trying to say that you should be having 1 year of relationship. Taking one example, I am an unrelated individual and I go to HDFC. They tell me that I have to go to the ICAI bank in order to invest in the company. Since you should be having the same.
Sir, unless whichever may be, whatever, whoever may be your banker, sir, unless you have 1 year relationship with that bank.
No, in this case, I will have to invest through an HDFC bank because another individual has invested through HDFC.
You will have to wait.
I'll have to wait for 1 year.
Yes, that's what the banker will say. But it's a very practical question. It's a very practical question. I have not handled such cases where somebody has already invested. I want to go and invest, but I'll have to go to the same bank. Then I will have to wait theoretically, I will have to wait for 1 year to establish a relationship. But the corporate overseas will not wait. So probably we'll have to look at a via media.
But in this case, they transfer for the other individual who just opened the bank account very recently in HDFC. They transfer this
and ask them to send the money and later on make the share transfer. Possible. Can we move on, sir? Permitted sector. ODI is permitted overseas entities engage in activities that are permissible both in India and abroad. That is the key here. So the activity that the company or overseas company is going to pursue should be an activity which is legal both in India and abroad. Right? Prohibited sector, real estate, gambling and dealing in foreign financial products linked to INR. So you cannot go on real estate. Dealing in real estate, you can buy land. LRS permits you to make an investment, buy land. But you cannot trade. Real estate business cannot be done. This is where the overseas investment starts. Overseas investment, we have two. The total financial commitment for any overseas investment, we have what we call as a total financial commitment, and overseas portfolio investment, which is under listed companies. Under the financial commitment, we have the overseas direct investment, investment in debt instruments, which is not an OPI, and non-fund based facility, non-funded facility. That is guarantees.
Which is not OPI and what is OPI?
Portfolio, overseas portfolio investment. Whereas you have the in case of listed companies, right? So overseas investment, you have two categories: financial commitment, that is the overall financial commitment that can happen, and you have the overseas portfolio investment, that is on a listed company. And under financial commitment, you have overseas investments, you have investments in debt instruments, which is not a public company, and we also have the non-fund based facility. Non-fund is your guarantees, bank guarantees, performance guarantees, etc., etc. Mostly these corporate the guarantees are only by corporate entities, not by individuals.
Sir, in that financial commitment means it's ODI, investment in debt and non-funded facilities. And the top la vandu neenga overseas portfolio investment OPI kuduthirukeenga. So that
OPI is a different category altogether, sir.
Different category. Okay.
Your overseas investment is nothing but your total financial commitment, right? Adula Total financial commitment, like you have the overseas investment, which is primarily into your equity. Then you are also permitted to invest in debt of unlisted, and you are also permitted to give non-funded facility like bank guarantee, SBLC, performance guarantee. Because many times what happens is the holding companies in India and they would have invested abroad as a subsidiary company. The subsidiary company's vendor, somebody will want a bank guarantee from India. The bank guarantee of the overseas company, and it will be supported by a holding company in India. So bank guarantees that come under the non-funded facility.
So why they call it as a financial commitment person?
Sir. Very simple. Debt. I mean, when you give a performance guarantee, if you fail or if the performance is not happening, there is a commitment for you to give.
By the Indian.
Obviously. It's a contingent liability. Upon happening of something, you will have to pay.
But ODI, why does it come under financial commitment? Because we have already done the investment.
These are subscribers
No, in tranches. It may be tranches. Investment may be
tranches.
Financial commitment is the total amount to be invested. It may be $1 lakh this year. Tranches.
It depends on what kind of agreement you have. You will say that I will invest over a period of time. Maybe you will subscribe for their debt. Right?
And with the overseas portfolio investment, what is
I'll come to it, sir. That is more to do with the listed companies.
Okay.
Yeah.
What's the cap from this 40% on net worth rate?
I will come back to you, sir. In case of overseas investment, it is 400% in net worth. In case of listed entities, it is 50% of your net worth. That's how it is. Financial commitment, investment in equity of overseas entity. You have the answer for your question, sir. Investment in unlisted debt of overseas entity, non-fund based facility, that is guarantee, or considered as financial commitment. All the three put together, the sum total of all the three is called the total financial commitment. Or financial commitment can be done only when there is an investment in overseas entity by an Indian entity and not otherwise. So, veruma debt mattum veruma guarantee kudukuren appdi panna mudiyadhu. You should have some relationship. I will say that I will probably equate this to a margin money. When you buy asset from a bank through a bank funding, the bank will want us to invest some money first. Maybe go and buy a car or a two-wheeler or whatever asset. They'll want us to. They'll fund only 90%. So the 10% is ours, which is a commitment. Similarly, unless you have some equity stake in the overseas entity, the lawmakers does not want us to give a guarantee on this thing. A resident individual cannot invest in unlisted debt or extend non-funded wealth. Why? Because resident individual, if he gives guarantee, it is bottomless. It could be exposed to greater risk. So that's why it is limited only to corporate, because corporates again may have limited liability. That is the, maybe that should be my interpretation or my understanding is, maybe that should be the intent of the lawmakers. Can we move on? Sir, can we break here, have tea and come back and then continue?
We'll do that.
Okay. Yeah. Thank you, sir.
The material could have.
If you have had a break, you probably would have thought over it. Any questions? I'm ready here to answer. Me. I can share. If there are any doubts, I can share, I can explain, or I can see. Or we'll move forward. Another question. So financial commitment is investment in equity of the overseas entity, investment in unlisted debt of overseas entity, fund-based facility, non-fund-based facility, which is nothing but the guarantees. So the sum total of these are considered as a total financial commitment. And financial commitment can be done only where there is an investment in the overseas entity by an Indian entity or not otherwise. That means there has to be something like, that's what we are talking about, margin money in debts, where we borrow money from India and Indian banks. So this is where we stop. I think from here we will move on. Guarantees, corporate or performance guarantee by Indian entities can give corporate or performance guarantee. Corporate or performance guarantee by the holding company, the Indian holding company, the Indian subsidiary company, or promoter group company in India. Who can give? These are three people. That is, the Indian company is giving a corporate or performance guarantee to the overseas entity, which means it can be the holding company of the foreign entity, it can be a subsidiary of the foreign entity, or it can be a promoter group company. Personal guarantee by resident individual promoters, personal guarantee by individual promoters of the group companies is permitted. Bank guarantee backed by counter guarantee or collateral guarantee is also permitted. This can be done. What the previous slide, what we saw was overseas investment, ODI. Now it is, what is the overseas investment part of? Now it's going to be overseas direct investment. Overseas direct investment is investment in equity capital of an existing unlisted foreign company. Overseas investment is investment in equity capital of an existing unlisted company, subscription to the memorandum and articles of a foreign company, investment in equity capital of a listed foreign entity. That means either investment in equity which is already existing there, where you send your money there, or you subscribe to the memorandum and articles of association, or you buy the shares of a listed company. In case of listed company, to acquire more than 10% stakes in the foreign entity, to acquire less than 10% stakes in the foreign entity with control. Control plays a major role in an ODI, a transaction. Whether you have, the first question they ask whether you have control or not. Apart from your investment that is happening, whether we have control or not, it could be one major question that we need to answer or we need to decide whether we should have control or not. Say for example, I'll move forward and explain this. What is control? That is, right to appoint majority of the directors by the Indian investor in the overseas entity. Control plays a major role. Right to appoint. What is control? Is right to appoint majority of the directors on the board. Right to control the management or policy decision. You play a major role in making the decision or taking a decision there. And 10% or more of the voting. If you have all or any of them, it is deemed that you have a control over the foreign entity. Control is very, very important here, especially in case of where you are making investment abroad.
The right to control management or policy decision, so unless they have the director appointment, எப்படி கண்ட்ரோல் பண்ண முடியும்?
சார் இப்போ இந்தியாவிலே எடுத்தீங்கன்னா நிறைய இடத்துல வந்து ஷேர் ஹோல்டர்ஸ் அக்ரிமெண்ட் போடுறோம், இன்வெஸ்டர் போர்ட்லேயே இருக்க மாட்டோம். ஆனால் நோ டெசிஷன் கேன் பி டேக்கன் வித்தவுட் தி கன்சென்ட், ரிட்டன் கன்சென்ட் ஆஃப் தி இன்வெஸ்டர்னு நம்ம நிறைய ப்ராசஸ் போடுறோம் ஷேர் பர்ச்சேஸ் அக்ரிமெண்ட்டில், இன்வெஸ்ட்மெண்ட் அக்ரிமெண்ட்டில். அதே போல் ஓவர்சீஸில் நீங்கள் இன்வெஸ்ட் பண்ணும்போது they will not, you can have an agreement saying that I will not have board control, but for certain decisions or major decisions you need to come back to me. So you have indirectly or directly you are having a control. Through an agreement you can enforce that. That's what I am trying to say.
So shareholder.
As a shareholder. The whole process only when you become a shareholder, you are making an investment. You are already a shareholder. Sometimes அங்கே என்ன நடக்குது என்னன்னு தெரியாமல் இருக்கும். சரி போர்ட் சீட்டே வேணாம், பட் I will only take decisions, or you need to consult me for all decisions. That would be possible. In fact, India, this is share purchase agreement. Overseas is investment over. They will invest here. They will not want to have a board seat. And a director of the liability, I am not advice. But they give you a list of items where almost everything. You cannot do this. They have drilled down to saying that if you are going to appoint any employee who is going to cost more than 25 lakhs per annum, then you need to have employee appointment, employee welfare measure. Everything they are controlling from there. Similarly, we can have control from here without a board seat. Can we move on, sir? Overseas portfolio investment. Investment in a listed foreign entity to acquire less than 10% stake. What is portfolio investment? That is direct investment is normally they talk about unlisted companies. When it is a portfolio investment, it automatically becomes a listed entity. So investment, I think, are the letters clear?
Bit light, but then it's okay.
They will break up with it. The front level, LRS and Companies. So overseas portfolio investment is again divided into three. Investment in listed foreign entity to acquire less than 10%, more than 10%, and investment in listed debt securities. If you look at investment by resident Indian to acquire less than 10% stake in listed company, there is ESOP, sweat to equity and qualification share. This can happen. Sir, you had some question?
Yeah. Actually,
sir, my code.
Whether a company like US can give shares by following the rights to somebody, they can avoid it.
But is there any outflow of foreign exchange? Is there actual investment happening?
Yes, there will be an investment happening.
Then you will not have a problem at all.
But there should not be.
There should not be a problem.
If there is a discount rate or whatever, it does not matter.
You will have to do a valuation of the foreign entity where the investment is happening. The investee company's financials will have to be all valued. A valuation report has to be given, and based on the resident individual.
But we are talking to RBI
to the AD bank.
To only AD, but it has to.
It has to. You will have to file. You will have to give various documents, including your Form FC, and say about the investment, because you are going to send money abroad. It's a normal.
Normal. The only one thing is why they are giving. That is the question. Whether it is because under this only for the but they are also working for some companies here which have some relationship with that company.
See, by and large,
RBI is not an ESOP or it is not a.
No, sir. As long as your
money is flowing
out,
and the valuation is done.
Valuation is done, and it is an arm's length valuation, is an arm's length basis. They don't go into the source of why this investment is happening, what is the basis on which the shares are getting allotted. Whereas this is applicable in case of a FDI. நான் இங்கே ஷேர்ஸ் அலாட் பண்ணும்போது ரைட்ஸாக கொடுக்குறோமா இல்லை ரெனியூவல் பண்ணுறோமா இல்லை ப்ரிஃபரன்ஷியல் ஆஃபரா சப்ஸ்கிரைபர்ஸ் மெமராண்டமா அப்படின்னு நம்ம கேட்போம் இங்கே இன்வெஸ்ட்மெண்ட் வரும்போது ஓகே பிகாஸ் தேர் த ரெப்பர்கஷன்ஸ் இஸ் வெரி சீரியஸ் in case of a FDI.
But whether they can give it to any private limited company also, they can give like that?
It can happen subject to their respective limits. Individual is $250,000. Other entities are 400% your net worth. If the entity is a listed company, then it is 50% of their total net worth.
From that?
Yes. And the company, எல்லாமே அந்த company சார்ந்தது. 400% individual are the $50,000. நம்ம net worth இது ஒண்ணும் கிடையாது. Every financial year, see that advantage, the difference between the LRS and the ODI here in terms of money, your $250,000 is fixed. Maybe you have to spend more and more in Indian rupee, because today it is 83 rupees. It could become 85, it could be 90. So you have to put in more money to send that $250,000. But $250,000 is fixed unless RBI revises it. But in case of 400% of net worth, the net worth can keep increasing year on year. It can also reduce, no doubt about it. But by and large, it can keep increasing. Your reserves can keep piling up, increasing. Your capital can keep increasing. I've seen it. Yes.
400% of net worth as per latest audited balance sheet.
Correct.
Is it 31st March or we can get it financial audited and get used?
It's a very good question, sir. There are banks which accept it if you do a proper audit and give them an audited balance sheet, because the law says it does not say about audited balance sheet as of the end of a financial year. It says audited balance sheet. You can do it as of 31st December 2024. Right? And you can give it a, say it's an audited balance sheet, it's an auditor's report. Right? See, I have one line to add here. I just want to share an experience. In one of the ODI cases, the Singapore entities, there was no requirement for the Singapore entity to have their balance sheet audited. So what they did is, there was no requirement. And auditing there was very expensive, it seems. So they hired a chartered accountant from India to do the audit. They did the audit. But when they gave their report, they gave it with some various other clauses like this is done only at the request of the company, this is done only for the purpose of APR. Otherwise, they had put in various clauses, various disclaimers or whatever. Banks refused to accept. Banks said, give me a plain audited balance sheet with your report, I will accept. Not with these. So in your case, if you are going to do it as on 31st, even though you are closing it on 31st March, but now if you want to do it because you feel that net worth could be better, is 31st March vis-a-vis 31st December, you can still do it. Bankers may accept. Because the law says audited balance sheet. It's not there at the end of the financial year. You need to check with your AD banker before you do this exercise. Right? So that is possible. But bankers, you have to choose your banker and check with your banker about this and then.
You are referring APR, what is it?
Annual performance report, sir. This I will come to it at the end. It's one of the reporting that has to happen based on your timelines. Because reporting happens based on corporate actions or based on timelines.
Individual investment through stock broker we can include.
Yes.
Whether we have to use
LRS. Anything you want to clarify, sir?
through only AD bank.
Yes. Sir, transactions that is not through normal banking channels, transactions that are not reported to income tax is deemed to be hawala. Very simple. If you are disclosing it in your income tax returns, if you are through normal banking channels, then it cannot be an hawala. So you have to go only through your bank and there is no way out. Limits. Indian entities can have overall financial commitment which is equal to equity plus debt plus non-funded facility up to 400% of the net worth of the Indian entity as per the latest audited financial statement. Latest, that's what the law says, latest audited financial statement. Maybe in your case, sir, probably what you can do is get it audited, call for a EGM, lay it before the members and then tell them it has also been adopted by the members also. If it is not a restricted. Right? Because bankers sometimes may ask whether it has been approved by adopted by the members. Bankers may or may not ask you, but to be on the safer side, if it is a small company, if it is a private company with limited number of shareholders, maybe you can lay it before the members and tell them it has been laid before the members, and though the company law does not require that. Okay? Overseas portfolio investment in listed entities should not exceed 50% of the net worth. 50% of the net worth or 400% of the net worth, 4 times your net worth is of the Indian entity, which is of the investor. The investor, if it is a, I think, I think echo or are you able to see that? It's fine? Okay, sir.
So, partly because this individual entity, whether it will be the account For operating network, the contingent liability.
Logically, illa. There are so many chartered accountants, so I don't want to commit anything here. And honestly, I'm not able to answer your question. But logically, on the contingent liability, the contingent liability network, I mean, definitely, it's a liability that can come anytime. It will affect your network.
When it comes to listed entities, there are many individuals who invest in stock abroad India. So, avalku the ODI now we have many apps which allow us to invest in foreign stocks. So, how does this impact all those investments?
See, again, you are going to send money. Maybe you may not send money to the company directly, maybe to the brokers there or whatever. You will have to go through the ODI process.
Okay.
It has to go.
Everything is an app and everything is easy. It's just like how I invest in Indian stock. Probably KYC is not different. So, is there something which we are missing on that end, or?
No, definitely. Even if the money goes from your account, but it goes through your banker only.
Yeah.
The app is only facilitating you to send money. End of the day, you are sending money abroad to your app. Right? That means it goes to it is debited to your bank. The best way is to approach your banker and tell them that you have made this investment and see that if you are able to get your investment regularized there. Okay. So, the 400% Indian entities network limits of investment by Indian enterprises. Indian entities can have an overall financial commitment of equity plus debt plus non-fund up to 400% of the net worth of the company as per the latest audited balance sheet. And in terms if you are going to invest in listed entities, it is 50% of the net worth of the Indian company. That's what the risk exposure can be as far as the ODI is concerned. So what is net worth? Paid-up capital plus free reserves plus security premium minus accumulated losses and deferred expenses minus miscellaneous expenses not written off. I think this slide is not for this audit. Your audience of this kind. I am taking poll to Newcastle. I think you guys know better how to do a net worth certificate. Maybe you would have issued net worth certificate in several cases. But as per the text, with my little experience, net worth is nothing but the paid-up capital plus free reserves plus security premium minus accumulated losses minus deferred expenses minus miscellaneous expenses. This is what it is. Because why I put this, I mean, to share a practical exposure, we wanted to make an investment abroad. That it was breaching that 400% limit and say. So we thought the best way is to bring more money into the Indian entity so that the share capital goes up. So when the share capital went up, the net worth went up. So we were able to make an investment. In case of LLP and registered partnership, capital contribution by partners plus undistributed profit minus accumulated losses minus deferred expenses minus miscellaneous expenses not written off. This is a simple equation. Probably I don't want to explain more on this. How does an investment happen? You can subscribe to the memorandum of subscription to the memorandum. It can be a private placement or a rights issue. It could be a bonus. It could be swap of securities and capitalization of dues from foreign entity. Where I am exporting my goods, the first 1, 2, 3, 4 are very simple. Maybe when I export goods, when the genuine dues receivable from the overseas entity, I can capitalize this. I can convert this into equity, provided it is from the, I mean, you have it is only in one financial year, and it is for the same bank, same company. So I can capitalize the dues that are receivable. So it can be subscription to the memorandum. I can send my money.
Do you have to go to RBI for taking, for converting the receivables into capitalization?
Sir, you will have to go to the AD bank through which your transaction is happening, a current account transaction. If it is a capitalization of dues, could be a current account dues or a capital account dues. So you need to go to your AD bank. If it is a current account dues, then you need to get hold of your EDPMS. So from the EDPMS, you know how much of money is.
I will go to the bank only if there is going to be a cash transaction or a cash transfer. But when it's going to be cash.
Sir, that is, see, to give you this thing, sir, you need to approach your AD banker along with, you need to first get your EDPMS. In the EDPMS, find out how much of money is due, how do you want to capitalize this. Then go discuss with your AD banker, give proper application so that it is getting converted and EDPMS is also knocked off. Going to the banker means, I mean you need to have discussed with your banker. I don't mean that you need to go physically to your banker and sit with him, right?
No, I didn't mean that. What I meant was, now I got your point, because in the system that has to move away from your receivables. So
sir, knocking it out from your EDPMS is very important, sir, when you convert, because that will be hanging in limbo.
Correct.
Unless when you do the transaction, along with the transaction, if you are able to knock it out, that's something different. So capitalization of dues from legitimate dues from foreign entity.
And the swap of securities means, how does it work?
Swap, maybe I give Indian securities and take foreign securities, right? So something like that. So swap happens between security to security. I give off one foreign security and take another foreign security from abroad. So all these things can happen. Swap, there are so many permutation combinations in swap itself. How this swap is happening, what is valued, how it is being valued, what is the consideration, is there different consideration being paid, returned to you as cash, or you are going to make additional investment? Because no two securities may be of the same value. This is something very interesting. No, when you want to make an investment, if you are under the scanner of the Enforcement Directorate or Central Bureau of Investigation or a serious fraud office, then when you want to make such investment, definitely you need to take the NOC. Getting the NOC may be difficult, but what the law says is, I will make an application for NOC, wait for 60 days. If I don't get any information or any rejection from them, it is deemed to be approval. But when you are under a scanner, because when you make an application when you file Form FC, along with the other declarations, you will also give a declaration that you are not under the scanner or you are not under the microscope of the Enforcement Directorate or the CBI or the Special Serious Fraud Office. You are going to give a declaration. So when you give a declaration, when you say that you are under ED, ED could be something else, it could be for some other capital account transaction. But still as a company you are under ED, you are a managing director of a company and you are also being summoned, then you are under this thing, maybe for a different transaction altogether, maybe for a different company altogether. But still you need to tell them here, yes, I am under the scanner of ED. If that be the case, unless you get a NOC from them, you cannot make an investment. For NOC, you make an application, wait for 60 days. If no refusal or response is received, you can say it is deemed to be the consent. But this is something very, very important, especially when you are the ED or when you are the ED. See, I tell you, in an inward remittance, when an investment happening in India, when I go for compounding, assuming that I am in the scanner, I've been summoned by ED for clarification. So the ED proceedings will keep going on. At that time, I find I can go for a compounding of the contravention. Maybe it is non-filing of FCGPR or whatever may be the reasons. So what I will do is, as the ED proceedings are going on, I will go file an application before the RBI for compounding the contravention. In such cases, RBI themselves will write to the Enforcement Directorate and take their no objection for compounding the contravention. So the ED matter will be going on, but I will still go to RBI to compound the matter. But RBI will go to ED, take that, because RBI knows that the matter is before the ED, they definitely check, confirm, and then only compound the offence. I have done such cases, especially in a foreign direct investment that has happened in India. When the ED matter was going on, I filed a compounding application. They checked with the ED and then compounded the matter. I paid the compounding fee. With the order, I went and appeared before the ED, told them it's been compounded, and the matter was closed there. So similarly, it can happen for your ODI, because the money is going out of India. They don't want the money to go when you are under the ED or the scanner. valuation of overseas investee company is needed for when? Is needed when issue of equity instruments to a Indian entity or a resident individual, purchase by Indian entity or resident individual from the overseas investor. There is already an overseas investor. If you are going to buy shares, if you are going to subscribe, then valuation is required. If you are going to buy shares from somebody, the valuation is required. So any cross-border transaction in terms of investment, whether you are going to get it from the company directly or whether you are going to buy it from somebody or whether you are going to buy it from somebody from India itself, then valuation will be necessary. So the chartered accountant will have to give a valuation. I don't think they don't talk about registered value. They are talking about valuation that we get from a chartered accountant. Under the Companies Act, yes, it is a different thing. You need a registered valuer for allotment of shares or whatever. But here they are only talking about valuation and the transaction to be at an arm's length basis. So these are the grounds on which a valuation would be required, purposes for which valuation would be required. Can I move on?
Is there any valuation basis, sir?
Internationally accepted methodology. Very simple. Normally for DCA whatever, wherever I've seen, they give you a discounted cash flow method. Probably because of the inherent advantages in the tweeting or whatever you want. Yes, sir, you had a question.
See, the valuation of overseas investee company needed So how do I validate the valuation report that has come from an investor company that I do investments? Is it because I only go for the top 4 CA firms who do the investment?
Sir, valuation, they are not talking about from whom to be obtained. The chartered accountant has to give a valuation. It is for the chartered accountant to satisfy himself on the credentials or the financials or whatever. Because if I am going to certify, I will ensure that I get all the information needed and then certify. The law does not talk about, or neither RBI nor the AD bank is not talking about somebody who is with 10 years of standing or big fours. They say chartered accountant valuation is good. Sir, I mean, cost is major factor, sir. There are, I don't know.
I'm not looking at the cost or who certifies. My point was not that. My point is, see, today as a retail investor, I am doing an investment. It is in my personal interest to find out whether the valuation is right, whether the valuation is correct, incorrect. Because I am going to put money, I have to get return on my investments.
Correct.
But how does the law intervene into this? Because that is where my concern.
Correct, sir. If the valuation of the overseas entities shares are valued only at 10 rupees, why should the exchange reserve suffer 100 rupees? Why should I pay a premium for the same? The value is only 10 rupees. The MRP, 10 ரூபாய் தான் MRP. அது 10 ரூபாய் தான் கொடுக்கணும். எதுக்கு 12 ரூபாய் கொடுக்கணும்? And the MRP is FDI is nothing but your valuation. Because money is going to go out of India. Reserves exchange reserves. See, similarly, look at it the other way. When the money is coming into India, the Indian valuation of the Indian shares are being done. When money is going to come into India as investment, as an FDI, what happens? The Indian enterprise is being valued. You accept valuation only equal to or more than that, nothing less than that. So MRP and MRP மேலே தான் இன்வெஸ்ட்மென்ட் வரும், அது கம்மியாக வர முடியாது. So உள்ள வரும்போது அப்படிதான், வெளில போகும்போது you can't extend more money. That is the basis of that. Correctness and all those things, the investor will have to take care. The genuinity of the figures, whomsoever is going to give a valuation will have to satisfy himself about the financials, figures, whatever he wants. And if the valuation is right, the investor will this investor's call. Maybe an individual, maybe a company or partnership firm. It's an individual's call to take, okay, genuine correct on the valuation is pannakoodadu. It's this call. But the purpose of valuation is your question. The purpose is exchange reserve. Government of India does not want to send more money than its value. Very simple.
And this is an unlisted company, basically. Because listed now, you will always see the valuation.
Yes.
What is there at the market.
Correct. Any question? Any other question? Yes, sir. Leave it to one more.
When it is a subscription to a memorandum, how do we get it valued?
There is no value, it's only the face value.
new company.
But still bankers will insist on it.
The bankers, probably you need to explain, or chartered accountant will have to give a certificate. See, originally, even in the FDI, this issue was there. In 2012, RBI came out with a circular and said, in case of subscribers memorandum of the Indian enterprise, valuation table. Therefore, when you are going to make a subscription to the memorandum, the chartered accountant can say that it is a subscription to the memorandum, hence the valuation is taken only at the face value, whatever the value. Then you cannot do a valuation. You cannot do a valuation. It's only I'm not very sure about the foreign law, but at least the Indian law, in the subscription memorandum can never be at a premium. Can never be at a premium. It can be only at par. Right? So, originally in an FDI was happening, we used to get a certificate from the chartered accountant on the valuation. The title will be valuation certificate, but it will say the company was incorporated only on this day, hence there is no valuation. Hence the value is only face value. We used to get a letter. In December 2012, the RBI came out with a circular and done away with the auditor certificate on subscription to the memorandum for the FDI. Similarly is applicable for ODI also. You can give an auditor, instead of a letter, your auditor will have to say that certified. Because we are also going to give you the charter of the foreign company, a certificate of incorporation. So those things will be an evidence that it's only a subscription to the memorandum. Right? Clear? Yes, sir.
Investment in overseas listed entities, they are broking app or whatever. We said it will not come under the ODI. I also concur with that because we are not investing in the company. We are listed brokers and we are buying the shares of the market. ODI complaints will not come to such a investment.
Sir, I need to check, sir, but I defer because ultimately you are going to you are creating an asset outside India by making an investment. You are not investing in a mutual fund.
Directly through Western, my client is investing $1,000, $2,000. The bank allows it subject to the conditions. It's money necessary by Amazon share or whatever. After 6 months, 8 months, he sells it, he brings back, he pays the tax, everything is online done. No one will file FC or FAQ or nothing.
Sir, I said definitely
Our point is, that's what she meant.
Yeah, maybe, sir. What she probably out of experience is talking about that.
I had a similar experience, but
sir, there is see, to my little knowledge on FEMA, there is a disconnect there. As a compliance, I'm basically a company secretary. I'm a compliance person. So you are going to invest in Amazon shares, right? If Amazon is going to give you a bonus, you are entitled for it. If Amazon is going to dividend, you are going to entitle for it. That means you are invested your money in a share, equity shares or some securities abroad. It's a source is not a matter. You are the owner. In the list of shareholders of Amazon, your name is there. That means that ODI has happened. What you are talking about using the technology, the platform through which investment is happening. Again, the bank account, your bank account is debited, money goes there.
Yes, exactly.
Right? As a compliance person, I will say that you will have to comply with this and then only do it.
Let the brokers do something to comply with this.
I need to check, madam. I'm not a techie guy at all.
Sir, there is one viewpoint here. If the investor is a non-resident Indian and if the investment is routed to an NRE account, then
there is no INR involved there at all. There is no INR involved at all. Right? Somebody is getting money from some dollar account, it goes there. Very simple. So you don't have to bother about it. But there is a clash between compliance and technology. You are using a technology to make the process easier. You don't want to go to the bank, so you use the technology. Simple. Your GPay, your PhonePe. I don't write check. Right?
The similar thing even in the Income Tax Act, when we transfer somebody outside India through a bank account, we need to furnish Form 15CA, Form 15CB, deduct TAs and all. But now we have Facebook ads where we pay in foreign currency, but there is no TDS compliance because we just click on the link and pay. Even again, even Income Tax Act needs to be complied with, but due to procedural aspects, they don't comply with.
Technology has made us non-compliant. Very simple. Yes, yes. Can I have? Just give me 30 seconds. Give me 2 minutes.
Please.
Yes, sir.
Sir, I have a very peculiar case. This is the ODI within the group.
Sir, in a ODI transaction or a LRS, no two transactions are similar. Everything is unique by itself. It's like human beings. Every person is different from the every transaction is different. You have all sorts of complications possible. Tell me, sir.
So within the group, ODI.
You have made a ODI.
ODI form we have for a different valuation and looking at that.
Okay.
It's for a 75% stake in the
Foreign company.
And after the remittance has gone, some negotiation happened, and the 75 stake increases to 90.
Okay.
Now it's how to regularize this. No remittance happens for the balance only.
For the same price, you are getting more shares. Advantage to India.
Correct. But how to regularize it?
Now you will have to file a revised FC. You approach, who is the ready bank?
Yes, bank.
Huh?
Yes, bank.
Yes, bank. You approach Yes Bank, where you would have already given your form FC and given and say that what is the money that is getting invested, what is the number of shares you are going to get, and what is the single.
Number is only increasing.
Increasing. So you need to go file a revised FC, tell them about this. Maybe this case they will take it up with RBI, get approval, and tell us. There is no approval because you are getting more for the less. For less. But you would have got the share certificate also. Give them the share certificate, they will have to change this in your project profile also. Because in project profile they only talk about, of course in project profile they only talk about the investment, not the number of shares. If I remember right, I am not very sure about it.
But possible.
Best case, sir.
One problem may be the valuation, how you have done the valuation.
It is less than they are going to, even if the valuation is done, even if it is valued 10 rupees per share, they have put 75% and they are getting more. If they are getting it lesser than the valuation price.
Advantage to the Indian company. First time you valued some expense for 70%. Now that same expense of 90% or 85%. The difference is the valuation is correct or not?
No, sir, it is based on, that's what he said, it is based on a negotiation. Yes. Probably he may have a shareholders agreement.
So all you will ask for questions, sir.
1 second, sir. You ask the question.
It's a problem for the auditor.
I don't say it's a problem for the auditor, sir. The auditor has given the valuation.
Correct valuation.
It is a correct valuation. That was the value. It is between the investor and investee negotiation happened for the same price they are getting more shares. No additional investment is going. For the same 75 rupees, he is getting 90%, not 75%. He invested 75 rupees and got 75%. Now for the same 75 rupees, he is getting 90%. Valuation remains unchanged. It is a negotiated deal. Probably the best way here is to have an investment agreement or an addendum to investment agreement to prove that this has happened. And it has to be routed through the AD bank. Your project profile is also getting changed. Yes?
So in your slide, there was a point which said that bonus issue will also come under ODI. I'm asking why should a bonus issue come, because there is no outflow of money. I'm already having a share, they are giving a bonus issue for that.
It is only reporting in a plain paper. You will have to report that to RBI. Because tomorrow when you get dividend, they will say you have invested lakh of rupees and they say give you a 10% dividend. So you are entitled to only 10,000 rupees. But the bonus could be double. So your 1 lakh will become 2 lakhs and you will get 20,000 rupees bonus. 20,000 dividend. So at least for that purpose, you need to report to RBI about the bonus issue. There is no outflow of money going out of India. Right? Similar, sir, in what we do in an inbound investment. When there is an investment happening, when bonus is given, you still file FCQPR. Similarly, you have to report. And your reporting in APR will also happen because your shares have doubled.
But I mean, only if it exceeds 10%, APR.
Yeah. See, bonus issue percentage may not increase, but APR, under normal circumstances, APR obligation will be there. Can I move on, sir? Yes, sir.
Sir, in one of
cases we came across that the client made the payment through banking channel to a portfolio management company. So they are investing in the listed stocks in US, like Amazon, Google, Apple, all those shares they are buying. So in that case, if it is covered under ODA, how do we comply with the valuation and other things?
Market It's a very good question. Let me check on that. It's a portfolio investment. So you will have some sort of basis on which the investment is. In both cases, see, to my limited knowledge on this, you invest only at 10 rupees because whatever is the unit price you invest. The number of units you get may change. Like what is happening in the mutual funds in India. My investment is only 1 lakh. The number of units I get could vary. Similarly, there you are investing in a mutual fund, something like a mutual or portfolio investor, and number of the same. And I tell you, the shares will not be in your name. The shares will be in only his name.
No. Shares are in the investor here, the name of the person investing here. But they are only managing what number of shares, which company, all those things they decide. This investor does not have any control over that.
If that be the case, then you will have to comply with the FEMA requirement.
So will it be an ODA?
Yes, it will be ODA because at the end of the shares, your name is written on the share certificate. You have made an investment. Anything good or bad based on that investment is accruing to you. Correct?
Yeah.
Maybe good or bad meaning there is a diminution in value. It is going to hit your balance sheet. If there is going to be a bonus or dividend or rights.
Yeah, they are getting dividend and other things.
So you have created an asset outside India.
Yes.
So it's in your name. You will have to go through the process. Maybe there's an agent, that person, by whatever name you call it, he is advising on where to invest and you are sending the money to him.
Yes.
He is investing.
Yeah, the money
you will
sent
have to go
them,
through your.
They only invest.
Yes, you will have to go through that. See, this is exactly where there is a mismatch between the process and the regulation. You are talking about apps. A transaction happened between two resident individuals. 15 CACB, income tax is not getting complied with. You are making investment through an app outside India.
So for this, the bank did not ask for any ODA related forms.
Maybe bank, you will have to go and ask the bank about this thing. Many times, madam, money has come from abroad as loan. Banker has straight away credited to the account. I told my client, look, this is an external commercial risk. He has clearly FIRC loan from overseas invest from the subsidiary company.
So payment was probably made through LRS, but ODA compliance was not.
You need to approach your banker and clarify this because banker may not know what exactly has happened because they don't know how you are trying. They cannot keep track. Practically impossible.
Yeah.
They cannot keep track.
Okay.
We'll move on, sir. So investment by resident individuals and Indian enterprise, this is what the difference is. The investment limit subsumed in LRS, the limit of $50,000. So individual investor, the limit, whatever may be the number of shares, whatever may be the number of companies, it is only $250,000. Whereas in an Indian entity, it is 400 times the net worth. As I told you earlier, this $250,000 will remain constant. Maybe the dollar price will go up, you will have to spend more Indian rupee to get the $250,000. Whereas in terms of if it is a private entity, your net worth may keep increasing year on year. You can put in more money to increase your net worth also. Whereas here you have to put in more money to get the $50,000. That is constant and that is variable. Right? Financial commitment can only be by way of equity and debt. Here the financial commitment can be by way of equity, debt or non-fund exposure. Why individuals are not given non-fund exposure is the risk is very high. I give a personal guarantee to somebody else abroad and somebody defaults. My entire asset, I'll be on the streets. Whereas in case of corporate entity, they can manage it. Or I can only invest in operating entity abroad. That means it can't be dormant. I can only invest in an operating entity, whereas investment by an Indian entity can either be in operating entity or in a special purpose. I can create a special purpose vehicle. Today my client is working in the US is creating a special purpose vehicle only for getting investment into India. They have created a special purpose vehicle where so many resident NRIs staying in US are going to invest into that company, and that company is going to invest in one company in India.
Can you give an example of SPVs, special purpose?
That's what I have given you, sir. Investment.
What does special purpose?
It is created for a specific purpose.
Specific project?
Yes, specific project, specific purpose. A foreign entity cannot create step-down subsidiaries if it is a resident individual. The logic, to my little understanding, if I go to invest in a company and have control also, the foreign entity cannot go and create a step-down subsidiary, because my domain knowledge could be, say for example, IT, software development. I go create a entity outside India for marketing and I make an investment there. Now that company wants to invest elsewhere. As an individual, it will be extremely difficult or near to impossibility for me to manage not only the company which I invested and also the step-down subsidiary. Managing two families could be difficult. That's why probably the lawmakers have said, if it is individual, you cannot create a step-down subsidiary. Whereas in a corporate entity, I can hire people. If I want to invest, I can always create a step-down subsidiary and keep moving forward on that.
There is a limit or something, they have said 2 subsidiaries or something.
So in case of corporate entities, 2 layers. Yes. This is where actual compliance starts. Yes, sir.
So in the case of foreign entities, I understand investor. How can I dictate terms?
Whether you have control.
Only if I have control.
Whether you have control.
Okay, that is one thing. Second one, in the case of resident individual, you said we cannot take debt for funding. That rule does not apply in the case of ODI.
No, I didn't get it.
For companies,
companies can do it. So first is unique identification, UIN. Before you make an investment, you file all the requirements. You file the Form FC. You give the client request letter, Form FC, copies of your all the documents, board resolutions, copy of the PAN, passport, the memorandum and articles of charter of the investee company, and then get a Form FC also done and get a UIN before the investment goes out of India. So UIN is very mandatory for every company abroad. UIN is given. It is not for the investment. It is not for the individuals or not for the same. So if I create a company outside India, that company is being and the investment is happening from India. That investment you have a UIN for that. Irrespective of the number of Indian entity or resident individual making investment in the same foreign entity, only one UIN is created. I think briefly we discussed all this.
A person was there for last 4 or 5 years in overseas and have shares, and returning back to India, he became a resident in India. Now, what the company is doing for?
There is no complaint, sir, because those investments happened when you earned money abroad. So as he was holding dollars and dollars have been invested. I don't think you will have a problem with it. There is a change in residential status of the investor, that's all.
Yeah, yes. No complaints.
This complication is there even in FDI. So I invested and I was a resident in India, I invested in Indian company. I have changed my nationality, I have changed my thing. But the share remains the same. It is a rupee share, it is a non-repatriable share. So no compliance is required.
Only after UAN allocation you can transfer the share capital investment money, right?
UAN is mandatory. The authorized dealer handling the first equity investment transaction into the foreign entity will be designated AD bank, AD for that foreign investment. So you choose your AD bank. AD bank is very, very important. The first transaction to whom the money is being sent will be your AD banker. All subsequent transactions into the said foreign entity will need to be routed through the same designated banker by all the Indian enterprise, Indian entity or resident individuals who are making the investment. So everything will have to come, and there's only one gate. There's only one door through which the ODI can go. Surely to have control and nothing more, nothing less.
It's a culture of banks.
Already நிறைய கஷ்டப்பட்டு சார் 10 வருஷம் முன்னாடி மர்ச்சர் பண்ணிட்டு இன்னும் FIRC இல்லைங்கிறா KYC இல்லைங்கிறா இன்னொரு it's beyond your control. What is the simple? What is the branches closed? At least all the customers of this branch will go to this thing. You can always say that. But mergers are I'm going through hell because of so many. I mean, mergers of banks have been taken over. So prior transactions are. I don't have this, sir. I'll have to ask them. I cannot get you these details. Especially transactions which have happened between 2000 and 2015 or 430. So after which the mergers happened. So prior bank will record extremely difficult. Especially in ODI where the FDI where the FIRC, KYC and all this stuff is happening.
What if I close down the bank account, go in for a new bank account? I make an investment with 180. Due to my administrative reason, I am closing all my accounts in this bank, going for a new bank separately.
Further investment பண்ணனும்னாக்கா நீங்க அதே பழைய பேங்க் எங்க க்ளோஸ் பண்றீங்களோ அத லைவா வெச்சுக்கணும். இல்லனா you need to apply to Reserve Bank of India and say why you are closing and why you are moving to a separate bank. Okay. சரி இது வந்து எப்படி சொல்றது? பேங்க் பண்ணி ஏதோ ஒரு மினிமம் பேலன்ஸ் வச்சு பேங்க் வாங்கி நீங்க வச்சுக்கிறது நல்லது. இதை க்ளோஸ் பண்ணி இன்னொரு பேங்க்ல அக்கௌண்ட் ஓபன் பண்ணி RBI ல போய் இன்னும் கொஞ்சம் அப்ரூவல் வாங்குறது is difficult. If you are not going to make any investment, further investment, you have already made through X bank, you have already have your UIN number in place, then it's better to continue with the same. அந்த பேங்க் அக்கௌண்ட் எடுத்துட்டு போறோம் அவ்வளவுதான். If you close பண்ணி நீங்க மூவ் பண்ணீங்கனாக்கா
scenario disinvestment also I need to have that account.
Yes. அங்க தான் பணம் வரணும் தெரியும். Okay. You need trouble service. Yes sir.
Foreign entity is only unlisted or foreign?
Which one sir?
I mean to invest through a designated whether
money going out.
Then I guess for the previous questions which these people asked, I think the broker will be compliant with the things. Because if I am having only S bank or some account, I am making investment to that broker. I mean sending the money to broker.
See, I tell you there are two reasons. One, I am not tech savvy. I have not used these apps.
No,
in fact, no. Probably what you are saying is right. Maybe you are. Yes, maybe they are doing the compliance. The investor shall select one banker as AD banker along with the branch and route all transactions only to them. Route all transactions only through the AD bank. More than one investor, all investors. The same thing again. Probably it is being put in a slide. The same thing again. With your permission, I am moving on. What documentation will have to be given? The customer client request letter. Maybe banker will give you a format or maybe you can prepare it. The client request letter is the prime thing. Form FC, I think you have part A to G, everything will have to be filled up. The first two parts will definitely have to be filled up, and the last 5 parts depending upon what is the purpose for which you are making an application. Form A2 is purchase of your foreign exchange for you to any transaction or sending money abroad. Form A2 is mandatory, and PAN, self-attested PAN, be it a corporate entity or individual. Form FC, signed. Sorry, there's a repeat. I'm sorry about it. The second point and the fifth point are almost, it's the same thing. My apologies. ODI declaration. About this ODI declaration is primarily about your ED, serious fraud office, etc., etc. Resident individual ITR for the last 3 years, and certificate of incorporation. It's memorandum and articles of association, or maybe people call it as a charter. So whichever, you will have to give a copy of this thing. Elaborate note on the overseas investment. I mean, maybe if you, what is the company doing, what is the object, what is the business they are going to do, etc. Those things will have to be given. And source of funds, where from the investment is going to happen. Form FC is Section A talks about details of the Indian entity or resident individual. Section B talks about details of foreign. So the first two is mandatory for any whatever may be the purpose. Details of transaction, declaration by the Indian entity, certificate of the statutory auditor, reporting restructuring. This is for section F is for reporting of restructuring of the balance sheet or this thing, and the last is reporting of disinvestment. When it is sold, form part G will have to be, section G will have to be filled up. Originally it was called form ODI with effect on 27 August 22. Now the form has been renamed the form FC. Form FC will have to be given. This is one common non-compliance that happens. People make an investment and forget. They go on to the business, but they move on to the business. But it is a duty of the resident investor, maybe the Indian individual or entity or whatever. They have to ensure the share certificate is received and given a copy. Out of experience, my personal thing is, when you receive a copy, scan it and send it by mail, but the best thing is to give them a physical copy, take an acknowledgement and keep it in your file. Because later on, we don't know, because unfortunately, for some reason or the other, the bank staffs are getting changed, they are getting shifted, or maybe they resign, they are getting transferred. So, we will not have full control. The best is to keep a proper evidence of having submitted the share certificate as a compliance, one of the major compliance requirements. Yet another peculiar thing, in some of the foreign countries abroad, they don't have the practice or there is no necessity to give a share certificate. What do we do in such cases? Or they don't have a format. What I did is, I prepared a certificate in our format, probably without the words under the Companies Act 1956 or 2013. Rest all remaining the same. Sent it to them as a soft copy or as a PDF. They got it printed, because the way it is, they printed it, got it signed and sent it back physically. It was accepted. So when the overseas entity does not have a format or there is no requirement for under their law to give a certificate, probably we can do the certificate from here. In fact, a simple letter saying this to certify that so and so company has been allotted so many shares on so and so date, giving the name and address of the investor, was accepted as a share certificate, as a proof of investment. End of the day, the money has gone out of India. Whether it has actually been invested, whether it has gone to the intended purpose.
What will happen in the demat case? Demat case.
Demat case, at least you will have your client ID or whatever, no? That you need to give them as a proof. Here, the purpose for which investment has gone out has to be satisfied. The AD, you will have to satisfy the AD bank about giving them the share certificate. Reporting. Reporting again, you have time-based reporting and event-based reporting. Event-based are investment in equity. When the investment is happening, reporting has to be done. By and large, all cross-border transactions will have to be reported. In case of current account transactions, the export and import happens to the AD bank, so reporting is automatic. In case of FDI or ODI, reporting has to be done. In case of FDI, money comes in, they give you the FIRC, and that is not reporting. The allotment has to be completed and FCGPR will have to be filed. That is reporting. In case of ODI, you get the UIN number. Money goes out of India. It is not complete unless you are ensuring that the shares are allotted for the monies gone abroad. And you get a share certificate and report it back. That is reporting. So, event-based reporting, you have investment in equity, extension of debt, provision of guarantee, standby letter of credit, bank guarantees, pledge of shares, and mortgage. All these things are by and large covered in Form FC. Once you go, it's a simple form. Page number 1 and page number, I think 13 or 14 is very important because that gives you the entire instructions. People who have not done this earlier, you can go through the form, page 1 and the last page, that gives you clear instructions how to fill up the form, what is to be filled in, what are the annexures. The banker will be able to help us in getting it done. My experience is, when you talk to the banker, when you want to make an investment, there are bankers who are prepared to come to your doorstep to help you fill up everything, assist you in getting your UA. End of the day, they want business. Because it's become very competitive these days. In fact, a couple of experience when I wanted to ECB, I did the entire documentation. Banker, I sent them by mail, bankers came back, sat with me, did the entire, corrected the entire, wherever they wanted to correct. We called the client also, we printed it, got it signed. Unfortunately, the lender company representative was also in India. Across the table, we were able to close a deal. Maybe it was not a big deal also, 35-40 crores of ECB was happening. But I did the documentation, banker came with their team. So in the ODI, probably if you have a cloud, if you have a good connect with the banker, I think banker will come. This is a practical tip, that's what I'm trying to do. I'm sharing my experience. The banker will come to your doorstep to get it filled up. Again, it depends on the relationship that you enjoy with the banker. Time phase, annual performance report, APR will have to be filed. So, APR, you are given almost 12 months time we are given. I close the financials on 31st December 23. I have time to up to 31st December 24 to file my APR. Annual performance is more of a statistical information. My money has gone out of India. What has happened? Has it grown? Has it not grown? Has it given more dividend? What has happened? How it has grown? See, it's simple. I invest my money in a company in India. The AGM is being held. What do they do? The balance sheet is first adopted. So, okay, the balance sheet is correct. Okay, my money is safe. Then, whether there is any dividend, that's the second item in the AGM. Then who are managing my funds or my invested money? Appointment of directors. Who keeps track of the accounts? Whether it has been done properly. The auditors appointment. So the logic here is that similarly, if I file an FLA, when money comes into India's investment, what happens? The government wants to know, or the statistical authorities want to know how much I've invested, how it has grown, how much of export has happened by that company, how much of import is happening, how much of employment opportunity has been created because of the FDI, etc. etc. So it's more of a statistical information, but it is time bound. It is not based on any corporate action. You would have made an investment 5 years back, but year on year you need to file your APR. Unaudited financial permitted only in case where IE or resident does not have any control. But 99% of the bankers insist on audited financials of the overseas entity, irrespective of the host country requirement on audit. So what you do, you get the balance sheet, get it audited by Indian auditors, and submit it without any problem.
With the RBA or IAE?
It's an online file. This thing APR is an online physical file.
RBA or
RBA.
Sir, host country, how Indian auditors can?
Sir, with so many chartered, what do you want me to? You know better.
So the APR has to be filed with the company except starting also
investment, when did the investment happen?
In December itself. So it's December 31st also we want to do
Better. Sir, most very important thing which I forgot to put in the slide is on the LSF and the compounding. The cutoff line is 22nd, August 22nd. I think it was 22/8/22 that new guidelines and regulations came. If the transactions have happened before that, and if 3 years period has elapsed, then the compounding is we can go for LSF. But what the law says, they are giving you 3 years time period from 22nd August till 22nd August 2025. Before that, where there is irregularity, we'll have to compound it. We can go for a LSF and regularize it. Beyond that, we may have to compound it only. But the Reserve Bank or the AD banker will come on the investor heavily for these non-compliance.
Pending proceeding or no pending proceeding?
No, if you have already reported but there is a delayed reporting, you can make an application now and pay the LSF and close it. If you have not regularized it, regularize it now before August and get it, pay an LSF and close it. If you are going to grow beyond August 25, which is probably 7-8 months down the line, you will have to go through the compounding process. Compounding process, the process itself is cumbersome, and they have 180 days to compound, and the fine could also be much higher. So these are the details. I also administer a Telegram group on FEMA. It's a pure knowledge group. So people who want can ping me. I will from your Telegram account so that I can add you to that group. We already have some 450 professionals there, and it's purely FEMA, nothing else. No income tax, no Companies Act, nothing. So people who are interested in you can join. Maybe one thing I find in this group is, in this Telegram group is, people get solution for their problems in less than 24 hours. Whether you are in practice or in employment or whatever. When you post your query, there are a lot of people who come back with their suggestions and with theirs. Any questions before we wind up?
I just wanted to check. See, I came a bit late in the morning. So before when you started the session, did you cover anything on who are all the people who get covered under the FEMA regulatory act?
Like for you, whom it is applicable. I don't think I have told anything beyond this. To whom it is applicable, any individual, any resident entity who is making an investment will come through the corporate charge. Okay, sir. Thank you. Hope there are no questions now.
Right. Sir, we mentioned about that 400% is permitted of the net worth. See, normally the equity ratio is 2:1 like this. So equity debt come like this. So that 400%
of the net worth of the Indian entity you can invest. The law gives us a big saying. I can invest up to 4 times my net worth. I can make an investment.
Four times.
You are only creating an asset.
But when it comes to the Companies Act restriction, so it is not more than 60%. All those.
Then you go to the shareholders and get the approval.
So yeah.
You go to the shareholders and get the approval.
Indian investing in overseas company just like that, giving it that means they'll be borrowing money and investing. How they will invest when the equity is certainly very much 100%? How can they invest up to?
Accumulated profit or sir. Accumulated profit or reserves or sometimes capital is 1 lakh. See, I tell you, in the recent case I handled, it was a 2006 incorporated company. Of course, they are 1 lakh. There was a capital, and they did not file anything. Today, last 6 months back, I regularized everything for them. But their accumulated reserve was 16 crores, and the entire 15 crores was sent as dividend outside India. But the capital was only 1 lakh. It was a cost plus model. Year on year, they kept on accumulating, and when they wanted to go and send dividends abroad, they were stuck. So they came to. So, where your profits are, you have earned money, where are they parked? As either reserves or your assets or whatever. Okay. Right, gentlemen. Thank you for your wonderful time. Thank you. Thanks for your patient listening.
Welcome today's speaker, P. Venkatesan, to occupy dais. It's my pleasure to introduce Venkatesan is a fellow chartered accountant, CISA, and FEMA consultant who has been practicing in Chennai for 47 years. He is specialized in FEMA over the last 29 years and rendering consultancy services to foreign and Indian clients, especially as a consultant to the Indo-German Chamber of Commerce for about 15 years. The World Bank engaged him as a consultant to carry out professional assignment in connection with some of his projects abroad. His book, External Commercial Borrowing, A Practitioner's Guide, has been published by ICAI. He has also been invited by ICAI to be an expert group for revamping the CA syllabus on FEMA. He has been delivering FEMA lecture at various forums of ICAI, as also for Society of Auditors, Madras Management Associate. At RBI request, he has been making suggestions for amendment in FEMA regulation for the benefit of stakeholders in general and entities whom CA represents in particular. He representing various companies from individual before the RBI and Enforcement Directorate on all FEMA related matters. He represents foreign and Indian companies with the concerned Ministry of Government of India in relation to application for approval of foreign direct investment under the government route and any other matter requiring government approval under FEMA regulation. It's our pleasure to have him. I request C. Suresh sir to present the memo to our speaker. Hand over to a speaker.
See, 15 AC and 15 AB are, post the filing of the tax and, remittance of tax paid by the investor, only then he is supposed to remit the money back. So that takes care of the income tax, dues what the investor is.
Agreed, sir. My question is, you insist on payment of TDS only for income-related remittances, not for investment-related or loan-related remittances. So why are you asking an individual who is making an ODI to pay 20% TCS? What is the logic?
There's no logic.
A large company which makes an ODI up to 400% of its net worth is not required to do this. But a poor guy who wants to invest, relatively poor guy, who wants to invest 30-40 lakhs, this small change, no? As foreign investments, overseas investments go.
In the lighter vein, to do all these kind of things, there are better investment avenues in India that he can do and still make his money without getting into this tax problem.
You see, there's also, not all investment decisions are rational. Many of them are emotional. This is a Muslim couple. They have relatives in the UAE who are already doing a business and they wish to participate in that business. So these are emotional decisions.
Sir, but I have only one question here. See, what is the liability of a banker? See, RBI very clearly says, don't get into tax matters, leave it to the taxman to decide. That was the statement. Okay. Now, if the authorized dealer, the AD, goes ahead and makes the payment of 1,50,000 without emphasizing on the customer to producing the TCS certificate, what is the liability in the worst case scenario that is going to happen to the AD?
The ADs are more royal than the king, sir. It's much easier to deal with RBI than with the AD bank, especially if it's a foreign bank. I was invited to one of the FEMA conferences in the Reserve Bank of India. It was presided over by the Chief General Manager from Bombay. So we were all assembled, we were waiting for the meeting to begin, and this gentleman says, ladies and gentlemen, please excuse me, the next 5 minutes are purely between RBI and HSBC. Will the HSBC representative please stand up? The HSBC representative stood up. He told her, if you people don't know FEMA, come to RBI, we'll give you training. You have no business doing what you are doing to your customers. What do you want us to do? Cancel your AD license or what? This is how the FEMA conference started. So, I mean, in the case of foreign banks, it is a combination of ignorance and nonchalance, disrespect for Indian laws. But in the newfangled private banks, we have a different experience. They get these kids just out of college, polish up their English and put them at the front desk in the new private banks. She doesn't know Negotiable Instruments Act. She doesn't know FEMA. She is completely innocent of all these things. Okay, you go and try to file an FCGPR. Now FCGPR has gone online. But previously when we had to file it physically, you go and explain the transaction to her, ask her to forward it to RBI. And if she tells you, I completely understand your concerns, sir, you can be sure she has understood nothing. So what does she do? She sends it to her compliance team, so-called. I call it the obstruction team. In most of the banks, it is an obstruction team. She sends it to the compliance team in Bombay or Hong Kong or Berlin or wherever. And the worthies of the compliance team don't talk to you and me. They talk only to this poor ignorant girl. She cannot understand the queries of the compliance team and she cannot understand my answers. Who pays? My client pays. RBI for the delay. This is what has been happening. And RBI is blissfully unaware or uncaring about the kind of abysmal FEMA service the AD banks are giving, because AD banks are all pampered children of RBI, you see. If you make a complaint to RBI against an AD bank, they will call the AD bank for inquiry without calling you. This is their natural justice. Anyway, some of these things have gone online. That is a relief in a way. But I don't know how much of a relief it is. The whole process takes longer, because previously you could sit across the table and try to convince a human being. Now you have to convince an app or a website, a firm portal or Prava portal or some such. It will keep on throwing up errors, and whatever answer you give will not be acceptable. Then you have to go to the AD bank. Now, in addition to the AD bank, you have to convince the portal also. Previously, you only had to convince the AD bank. So I don't know if we are jumping from the frying pan into the fire. Oh dear, I don't know if we have time for compounding at this rate. So can we move on this subject? Can we move on to the next one? I'll try to keep this as brief as possible. I only have half an hour left, unless you have questions, in which case I may have to shell this topic and take your questions and finish by 3:45. Otherwise I can quickly run through the new compounding rules, whatever you prefer. Shall we do it? These are the new compounding rules. Before we talk about the new compounding rules, I want to give you a bit of background. See, this is where it all began. Under FEMA, you have only one penalty provision, one omnibus penalty provision. Income tax is very creative. Starts at 500 rupees and goes on to 500,000 rupees. and then goes to 2711C, goes to 100 to 300% of the tax sought to be evaded, not the income concealed. Please note, it's only 300% of the tax sought to be evaded. That's the maximum. But under FEMA, we have one omnibus provision in section 13. There it goes. Not only serious offences like Hawala, harmless things like this, well, that 5 million does not apply anymore. That overseas investment, that doesn't apply anymore. That was under the old compounding rules which were enforced till the 12th of September 2024. But the point is, even for smaller transgressions which are not serious like Hawala, you still have only this one penalty provision of 300% of the amount involved in the contravention.
You have equivalent income tax also, 269 SSD also, 100%.
Okay. No, I'm saying that you have such a large variety of penalty provisions under the Income Tax Act. Everything does not attract 300%. But here everything attracts 300%. Even procedural lapses. Even delay in filing.
So that means a person who has done an ODI, in the same example that we have discussed now, 150,000 AED, he does not get the share certificate within a period of 60 days. So on the 61st day, technically speaking, RBI can levy a penalty of 450,000 AED on the investor who has done.
That's right, sir. That's what the law says. It's a legislative infirmity. In that very FEMA conference, I've been saying this at various FEMA conferences, both when I am invited to the FEMA conference in RBI and when I invite top RBI officials here for our FEMA conferences here. I've been saying this, that Section 13 is manifestly unjust because it makes no distinction between a legal transaction and an illegal transaction. For an illegal transaction like Hawala, currency smuggling, by all means you charge 300%, you confiscate, you prosecute, you imprison, do everything. He deserves all that for acting against the interests of the country. But when the money comes through normal banking channels, with a KYC from the remitting bank and an FIRC from the receiving bank, and the guy didn't know the requirement that he should report to RBI within 30 days, you cannot prescribe the same penalty on paper. In practice, yes, there is a compounding facility. So in practice, we don't pay 300% for all these procedural lapses. But such a provision should not have been there in the first place. For procedural lapses, they should have prescribed a nominal penalty. Like what you have under the Companies Act, there is an additional filing fee if there is a delay in filing certain documents. And that does not depend upon the amount stated in the PIS 3. Beyond a point, it does not depend on that. Whatever may be the amount is 600 rupees or 1200 rupees or some such. That's not the case under FEMA. Because RBI want to create a very flourishing income stream for itself in compounding charges, they hit upon this idea of treating contraventions as quantifiable. If it is quantifiable, it can be compounded. If it is not quantifiable, it cannot be compounded. So what does RBI do? Treats most contraventions as quantifiable. Somehow or the other. How do you quantify? There is a branch of a foreign company, a license office of a foreign company, which was in existence for 3 years with RBI approval, and then continued to be in existence for several years without RBI approval, and the bank account was frozen, and they sent money to another company in India and gave it to the license office to spend. All sorts of contraventions were done, and finally it ended up in compounding. So what does RBI do? They had to quantify the contravention, no? Every remittance which has come to them, from whomsoever, in whatever manner, add up everything and treat that as the amount involved in the contravention, charge compounding charges. The lapse on the part of the license office was not applying for renewal of the approval after 3 years. That is an administrative lapse. How can you link it to every amount that has been sent and charge compounding charges on that? This is how RBI has been interpreting Section 13 and treating most of the contraventions as quantifiable. That's a blessing in disguise, because if RBI does not treat it as quantifiable, no compounding is possible. Then you have the Damocles sword of Section 13 hanging over your head with the 300% risk all the time, ruining your sleep and that of your client. Under Section 15(1), you can go for compounding. It is supposed to be a voluntary process, that's what RBI tells you. It's like that, what is Section 58 of Partnership Act, is it? I don't quite remember the number now. Where registration is not compulsory, but if you don't register, no claim can be made between partners, no claim can be made by creditors. It's similar to that. Compounding is a voluntary process, but if you don't go through the voluntary process, you are facing 300%. That is how voluntary it is. See, previously for procedural lapses, RBI used to issue cautionary advice. It's a slight slap on the wrist. No, it's not a knife on the neck. Slap on the wrist. Hey, go and behave yourself in future. Don't do this. Report your transactions promptly. They'll give you a homily, they will give you advice and send you away without penalty. That was called cautionary advice. But by this APDR circular, RBI has done away with cautionary advice. They thought, why lose that money? Why lose the compounding charges? So take away cautionary advice. File compounding applications for all lapses, big and small, and everything in between. RBI makes more money. This is of interest to us, ladies and gentlemen. See, when you make a compounding application, RBI is required to pass a compounding order within 180 days. During the 180 days period, RBI will grant you a personal hearing. For granting you a personal hearing, RBI will send an email to your client. And in that email, RBI will say, don't engage a consultant. Because it is a voluntary process, it is an admitted contravention, you don't need to engage any consultant or advocate or chartered accountant or company secretary or anyone like that. Just come directly to us, we will compound the contravention for you, charge the compounding charges, pay it, and it's over. This is the marketing line that RBI has been taking in all compounding cases. Look at FAQ 10 and 11 on compounding. We find this stated policy of RBI to advise companies not to engage a consultant. So once for one of our FEMA conferences here, I went and invited the regional director of RBI, Mr. Sadakadullah, and the general manager of the Foreign Exchange Department, Mr. Chalam. They both came here. I got my chance. I gave it to them. I said, what business is it of RBI, whether the company engages a consultant or not? Why are you getting involved in this? Does the Supreme Court tell any litigant, don't pay so much to A.M. Singhvi or Harish Salve? They pay because they see value in it.
Singhvi is a better example.
Sorry?
Singhvi is a better example.
Whatever, or Sibal, it doesn't matter. The point is, does Supreme Court give such a direction? They are leaving it to the litigants and the professional to decide whether the professional should be engaged. If the professional is engaged, how much should be paid to the professional? It's a matter between them. And no client is a fool to just throw money unless he sees value in it. So I told them, when they came here, let me tell you, it is not a question of my livelihood or the livelihood of any of my friends here. Because every time you have sent such a mail, my client has royally ignored your advice and come to me and given me a power of attorney to appear for him. So what do you achieve by doing this? An institution of RBI stature should not stoop to this level. But they continue to do this on the reasoning that at some point of time, some retired RBI officials formed a cartel, started a racket, approaching applicants for compounding, promising them the moon, saying that I know the compounding authority, I can get you a favorable order, and they were trying to, overcharge the client and all that sort of thing. But you cannot, because something like that happened, you cannot paint an entire profession with a broad black brush. Are there black sheep in the CA profession? Yes. Are there black sheep in the advocates profession? Yes. Are there black sheep in the Reserve Bank of India? Yes, of course. So what is the sanctimonious attitude? Why are you sitting in judgment on entire professions as if everybody is up to some shenanigans or hanky-panky? This is utterly undignified on the part of an institution like Reserve Bank of India to indulge in this kind of crass commercialism.
Not even getting into the area of how they look at you as a black sheep or whatever. But the very fact that they don't want to get into the income tax part of giving an interpretation on the tax part, they should not interfere into the client's space of engaging a consultant, not engaging a consultant. Then purely you're not going to pay for the consultant, he's going to pay.
It is non-binding, sir.
Yeah, it's non-binding. Supreme,
Of course, my client has ignored and he has engaged me, sir, every time. None of my clients has taken RBI's advice seriously. They have dismissed it with the contempt it deserves, and because they place their trust in me. So I have not lost anything. But RBI's stature fails with this kind of action.
Is the compounding order appealable, sir?
No.
So, when the 300% has been specified in a compounding order, how much of a difference does it make between the 300% what has been specified there?
Sir, up to the 26th of May 2016, it was left entirely to the reasonableness of the compounding authority and the sagacity of the FEMA consultant to bring it down from 300% to 1%. But it was all left to the discretion of the compounding authority, and it was up to us to convince him to reduce it as much as possible, depending on the merits of the case. But for the first time, RBI tried to standardize the compounding charges through this APDR circular of 26th of May 2016. And then it was incorporated into the Master Direction on Compounding. All subsequent Master Directions it has been incorporated, where you will find it as a computation matrix or something like that, where they say if it is a reporting contravention, it will be 10,000 plus 0.5%, if 1 year, 0.55% if it was 2 years delay, so on and so forth. And for different types of contraventions, they have prescribed different rates of compounding charges, where there is a particular contravention which has not been specifically dealt with above, it will be 50,000 plus 0.5 to 0.75% for a delay of 1 to 5 years. That has been provided. Now, is this good or bad? It is good and bad. It is good because the fear of 300% has been done away with. You have a certain predictability about what the compounding charges are likely to be based on the amount involved in your contravention. You can have a rough idea. It is not hard and fast. RBI can charge more or less than the indicated amount. In some cases where as per the calculation it came to 6 lakhs, I was able to convince him to charge only 1.5 lakhs. So that leeway is there for both the compounding authority and for the company's representative to try to convince him to reduce it. That leeway is there. But there's a certain amount of predictability. It is no longer anything up to 300%. So that comfort has been brought by this circular issued by RBI. But what is bad about it? What is bad about it is more fundamental. What is bad about it is penalty has been made automatic. By its very nature, no penalty can be made automatic. This is the authority for the proposition that no penalty can be automatic. In this case, the Supreme Court has given a wonderful exposition of penalty jurisprudence, and RBI has been merrily violating it. I will tell you what the Supreme Court said about penalty. Nature of penalty, as enunciated by Honorable Supreme Court in Hindustan Steel Limited versus State of Orissa, there is the citation. An order imposing penalty for failure to carry out a statutory obligation is the result of a quasi-criminal proceeding, and penalty will not ordinarily be imposed unless the party obliged either acted deliberately in defiance of law or was guilty of conduct contumacious or dishonest, or acted in conscious disregard of its obligation. Penalty will not also be imposed merely because it is lawful to do so. I will repeat that. Penalty will not also be imposed merely because it is lawful to do so. Whether penalty should be imposed for failure to perform a statutory obligation is a matter of discretion of the authority, to be exercised judicially and on a consideration of all the relevant circumstances. Even if a minimum penalty is prescribed, the authority competent to impose the penalty will be justified in refusing to impose penalty when there is a technical or a venial breach of the provisions of the Act, or where the breach flows from a bona fide belief that the offender is not liable to act in the manner prescribed by the statute. It cannot be more crystal clear than this. Supreme Court has laid down in no uncertain terms that no penalty can be automatic. But RBI has gone and made penalty automatic. That is what is bad about the change brought by RBI in the matter of compounding charges.
It's not challenged, sir, because we got a Supreme Court judgment. It's not challenged automatically.
Sir?
Was it not challenged, sir? Because the automatic penalty is a violation of the highest court of the land.
Nobody has challenged it because they are happy the 300% has gone away.
So gone away.
Now there is no further risk of 300% because RBI has said so much will be the compounding charge for this contravention.
Rate cut.
So pay it and buy peace and forget about 300%. The Damocles sword has been removed. Therefore nobody has challenged it, I think. But it is challengeable. On principle it should be challenged. I don't know when somebody is going to do it. Section 6.4 of FEMA has been violated so many times by RBI, it has not been challenged. Section 6.4 of FEMA says that a person who is resident outside India, who has come back to India, can continue to hold all his foreign assets abroad and deal with them as he pleases. No restrictions. But what does RBI say in its deposit regulations and its master direction on accounts, bank accounts under FEMA? If you have an NRE account, if there is a change of status, you must have it redesignated as a resident rupee account. This is a violation of Section 6.4 of FEMA. We have so many instances in our country which prove The good old proverb, Devam varan koduthalum poojari varan kodukala. This keeps happening at different levels.
King is above law.
Sorry?
The king is above law.
Huh. You don't even have to be a king to be above the law. So, this happens at different levels. The constitutional guarantees have to be passed on to us by the legislature. The legislature may dilute it. The legislature gives you a concession or a facility, as in section 6.4. RBI blocks it. So by the time it reaches the common citizen, Yana Pune adu.
It's a good time versus bad. ஒரு வாட்டி 50,000 ரூபாய் கொடுத்தாச்சு வெளில வந்தாச்சுன்னா who will spend litigation, filing a court application and
correct.
spending
I mean,
more.
it has to be worth your while.
It's worth your while. Your time is, you can spend, earn more money.
No, if you are a UHNI and if you want to deal with your money abroad, even after becoming resident, then you may take the trouble to challenge this. Otherwise, you wouldn't do it. You would simply convert it to a rupee account and be done with it. This I already talked about. LSF. LSF I don't have time to go into now. I mean, LSF for compounding charges. I will not go into that. I have to quickly talk about the new compounding rules. So, see, point is that up to, I think, about 4 crores of amount involved in contravention, LSF is advantageous, and beyond that, compounding charges are advantageous. LSF becomes more costly. And LSF in any case is only for reporting contravention. And it has been extended to overseas investments. Originally it was for FDI, then in 2019 it was extended to ECB, and 22 it was extended to overseas investments also, for a period of 3 years after it came into force. So if you have old cases of non-filing, better catch up quickly. Time runs out for overseas investments in August of 2025. This is the first time that the compounding rules have been restated. When FEMA was passed in Parliament in 1999, a flurry of regulations were issued by RBI and flurry of rules were issued by the Government of India on the 3rd of May 2000. The compounding rules were one of those. After that, it's for the first time that on the 12th of September 2024, new compounding rules have been issued, replacing the old rules. So we'll quickly look at the changes made. I don't want to tread on the time of the next speaker. The APDR 17, you can make a note of that. That explains the new compounding rules. First one is enhancement of delegated powers of compounding authorities for Assistant General Manager, Deputy General Manager, General Manager and Chief General Manager. They have been increased substantially compared to the old rules. That's the first of the changes made. Oh, before we go to this, one more thing. This is about the, how do I go back? This one?
But yes.
This one?
Yes, yes.
This is about the power delegated to the officials. But compounding itself has been delegated to different offices of RBI. FDI compounding will be done by the regional office. Compounding relating to immovable property, deposit regulations and PO will be done by the CO cell of RBI New Delhi. All other compounding will be done by RBI Central Office, Bombay. This is how the delegations have been done to offices of RBI. This is the delegation for officials of RBI. This portal has been created to facilitate online applications by NRIs, PIOs, OCI card holders and foreign investors who need to apply to RBI for various permissions. So without their having to make a trip to India and make a physical application, they can make these applications on this portal. And on this portal, you can also file compounding applications. So after this portal was set up, I called the help desk of Pravah sometime in September. They told me that hereafter you can file compounding applications only on the Pravah portal and not physically. But that is wrong. When RBI's Master Direction number 17 came on the 1st of October, I found that the Master Direction says you may file compounding application either on the Pravah portal or physically. So that physical filing facility continues to be available. And that can be very useful for us sometimes because you are asked to file the audited balance sheet of the company for the last 15 years. To scan all this and compress it as per the rules of the portal, 10 MB, 5 MB, whatever it is, a pain. Instead, just get printouts from the client and dump it at the office of the RBI. Your job is done. So it's much easier to file physically if there are many years balance sheets to be filed along with the compounding application. If it's a new company, it's different. But for an old company, it will be online filing will be difficult. And it's a new portal. You don't know how many glitches are going to be there. So let us not be the guinea pigs. Let NRIs, PIOs, OCIs be the guinea pigs for perfecting the Pravah portal. Let us file our compounding application physically in the meantime. These are all small changes. For 24 years it was 5,000 rupees, now they made it 10,000 plus GST. Oh yes, we are progressing. Previously you could only give a demand draft for 5,000 rupees. You could only pay the compounding charges by demand draft. Now you can also do an NEFT or RTGS. So RBI is catching up with technology, which is a good thing. And these criteria have not changed from the old compounding rules. They continue to be the same. Administrative action, this is very important. See, if you identify a contravention or if you receive a compounding memo from RBI, in either case you can file a compounding application, either on receipt of a compounding memo from RBI or suo motu you can file it if you have identified a contravention. Before RBI will entertain a compounding application, you must complete the administrative action. What is the administrative action? If you have failed to file an FCGPR return, file it. If you have failed to file an ECB to return for each month, file it up to date. If you have not filed an APR for your overseas direct investment, file it up to date. Or FLA, foreign liabilities and assets return, annual return. Whatever reporting you have failed to do it up to date before you can approach RBI. And if it's not a reporting contravention, suppose you have received a share application money and you have not made the allotment within 60 days, you should have refunded it within 75 days. If you have failed to do that, previously you had 6 months, then when they amended the Companies Act 2013, they amended the FEMA regulations also in tune with it. So now it is 60 days and 75 days. If you have failed to do that, then you cannot make a belated refund or a belated allotment without prior permission of RBI. So you have to get that permission before you can file a compounding application. So whatever remedial action has to be taken in respect to the contravention, suppose it is not a reporting contravention, you may have to file a condemnation petition with RBI or for an ex post facto approval of the transaction that you have done without taking RBI permission. Once that ex post facto approval comes, you can file a compounding application. You can say that I have committed this contravention, I want to approach RBI for compounding. Before that, please either condone this or give an ex post facto approval based on which I can file a compounding application. This is what is called administrative action. It must be completed before RBI will entertain a compounding application.
Tell me one thing. For example, if I do a foreign investment and shares have not been allotted to me within the time span of 60 days or something, and I get to understand from on the 50th day there's going to be a delay in the share allotment. So is it not possible that I go to RBI proactively and tell them that allocation is not going to happen? I need an extended time because that is what the company has told me that it may take.
You can do that. Usually it doesn't happen. For years people don't, they remain oblivious of these obligations. They wake up after several years, just like RBI. At least under the Income Tax Act, you have certain limitations. They cannot wake up after 25 years and issue a notice under 148. But under FEMA, there is no limitation. RBI can wake up anytime it pleases and issue a notice to you. That is the difference. So it can crop up anytime. So if you keep track of your transaction and if you approach RBI promptly for an extension of time, then in all probability it will be given. And in the case of export receivables and import payables also, export receivables you are supposed to realize it within 9 months and import payables you are supposed to pay it within 6 months. If you fail to do so, you can approach your AD bank for a routine extension of 6 months at a time up to 3 years. If it's delayed beyond 3 years, you have to approach RBI for permission for further extension. So these facilities are there, but clients don't generally, they are not aware, they don't do it, they wake up very late and then come and tell us, then we have to go for compounding. It may be too late to get any extension from the AD bank. Then we file a compounding application and seek that remedy to close the matter. Non-quantifiable contraventions cannot be compounded. Serious offences will not be compounded by RBI. Serious offences, if at all, will be compounded only by the Enforcement Directorate under Section 3A. A violation of Section 3A can be compounded only by the Enforcement Directorate. Any other contravention can be compounded by RBI. 3A is about hawala, about dealing in foreign exchange otherwise than through an authorized dealer, essentially hawala transactions. Those, if ED is inclined to compound it, only ED can do it, RBI cannot do it. All other compounding RBI can do. This is where you are holding foreign assets in violation of the Act. The AD has been given power under Section 37A to attach the assets of so-and-so in India. So if it's such a case, then RBI will not touch it with a barge pole. This is one change that has come about. Previously, you could not file a compounding application when an appeal was pending. Now you can file a compounding application even if an appeal is pending. Oh, this we already discussed. I think I have covered the ground just in time for the coffee break. Unless there is any question, I would like to thank you for your kind attention. If there is any question, I will take it.
Sir, just one small academic question, sir. You said that provision section 6.3 of the FEMA has been repealed. Section 6.3 of the FEMA has been repealed, and but it still survives in the form of rules and regulation. How can that be just academic?
Because they inserted section 47.3. It says that even though section 3 has been repealed, any regulation already issued under section 3 will continue to be in force until rescinded by the Government of India. Okay, thank you very much.
Welcome Kritika Tewani ma'am to Occupy Dias. It's my pleasure to introduce Kritika. Tewani is a chartered accountant with over 13 plus years of experience in advising clients on foreign investment and exchange control related matters. She has a thorough understanding of foreign exchange management regulation and has a practical exposure with respect to seeking regulatory approvals for various clients. He is also involved in advising clients on inbound and outbound investment structuring advisory, making license application to the regulatory and mapping changes in regulatory framework for various sectors, advising client on import-export compliance. She has conducted FEMA workshop across different client and sectors. Such workshops have helped the company put together all documentation at one place and to equip itself to address future queries from regulator and investor. And we are welcome. I request CA Lakshmi Priya Dashni ma'am to present member to our speaker.
I will talk.
And who will speak?
So, good evening everyone. I know it's been quite of a long day for you all, considering you've had good number of sessions before my session. So I'll keep my session very sweet and short for you all. Just a quick intro of my background, in terms of the professional experience that I hold and the expertise that we actually work around. I work with Deloitte. In the past, I was with PwC for almost 12 years, and it's been almost 2 years now with Deloitte. Our area of practice is regulatory. I don't know if people, if you've heard of this term regulatory, because typically CAs are associated with either audit or tax. But our area, or rather the practice area that we work, is regulatory. Now, what is regulatory? Regulatory is to do anything and everything non-tax in nature. And by non-tax, I mean it could be your food laws, it could be your battery waste management rules, it could be FEMA, it could be FDI, it could be IT intermediary guidelines. So anything which is non-income tax in nature is what typically we work on and work around. FEMA is definitely one part of it. One very important part of it. It used to be our bread and butter for the longest time, but now I think we've expanded our team. We're actually venturing into a couple of new areas and laws and legislation, such as data privacy, which is a sector which is quite evolving now, and I'm sure that as the rules will be notified, things will be quite fast and moving around data privacy. So that's typically the verticals that we work around. Quickly starting on to the presentation that I thought I'll kind of make you go through here is this is kind of very theoretical, and I thought that I'll keep the theoretical part very limited and make it more practical for you all, because FEMA, like I said and like Sir has said, it's all about practical cases that we handle. Today, if I'm asked to go through a particular master direction or a master circular or an APDR circular, it takes a lot of effort in terms of understanding. While if you actually handle a case alongside reading a master direction, it's only then that you'll be able to understand the essence of that law, or rather the rationale behind that law, why that particular law was framed by the Reserve Bank of India, or rather why that particular legislation or that law was delegated by the Reserve Bank of India to the AD bankers. So typically, we have the Foreign Exchange Management Act, we have the regulations, we have about the APDR circulars, and we have the master directions. These are typically accessible on the RBI website. If you go on the left, we have Foreign Exchange Management Act. You click there, you have the master directions, APDR circulars, clarifications, etc., which are there on the RBI portal. These are the key rules and regulations. I mean, I thought that considering it's something which is as vast as possible. If you ask me, after 14 years or 15 years down, in terms of working only on FEMA, I would say that to absorb all these regulations and to say that you are an expert is still something that I would refrain from saying, because all these regulations come with their own nuances in terms of interpretation issues, in terms of some kind of updations that have happened in the past. But this is what the gamut, or rather I would say the umbrella, is behind FEMA, with all the current account, capital account, you know, your FDI, LOBOPO, your ODI regulations, your reporting, compounding, etc. coming within the FEMA guidelines. Now this is the key, I would say, to understanding Foreign Exchange Management Act. You know, we talk about all these very complicated cases. You know, we have clients wherein there are payables and receivables which are outstanding for over 10 years, 15 years. Is net off possible? You know, can we have a bank account opened overseas? Can we have an immovable property? Can we buy an immovable property overseas? I would say we need to pause there and first understand what is FEMA all about. What does it really comprise of? And if you're able to understand the basic of FEMA, which is what is a current account transaction versus what is a capital account transaction, for us to crack down, or rather be able to give the value add to our client, will become very simple. And by that what I mean here is, typically, you know, all clients approach us and ask us, will this transaction require an RBI approval or not? And I'm sure you will be able to resonate with this, because FEMA is only about understanding, will this be under automatic route or will this require an approval route? Can the AD banker process it within their powers, or will it need to be filed with the RBI, considering RBI typically takes 6 to 8 months now to give an approval, if the approval is forthcoming. So the first and the foremost thing that we need to assess when we are actually reading and understanding Foreign Exchange Management Act is whether a transaction qualifies to be a current account or whether it qualifies to be a capital account. Now the basic, or rather the thumb rule in understanding a current account transaction and a capital account transaction is that current account transaction are typically any transaction which forms part of your P&L. A capital account transaction is something which, you know, leads to creation of an asset and liability outside India for a resident and vice versa. Now these are all very theoretical terms, and why I'm saying is that today if I'm asked, or rather if I would want to ask you, so if I have certain trade payables, how would you classify that trade payables as? It's a current account, right? But if those trade payables are outstanding for more than 3 years, I am given to understand by a majority of my clients that it becomes an external commercial borrowing. Am I right? Is that the understanding? I mean, typically, I feel that it's quite a prevalent understanding all over, that automatically, if I have a payable and it's outstanding for more than 3 years, it becomes an external commercial borrowing. External commercial borrowing by its very nature is a capital account transaction. Am I right here? I mean, anybody who would want to kind of correct me that it does not become an external commercial borrowing after 3 years? I mean, I would really appreciate that it's a dialogue, considering it's a last session and not a monologue, because then it will become that, you know, it's something that I really have to close it by 5:30 before the hall becomes absolutely clear.
I beg to differ. See,
Yeah.
trade payable outstanding for 3 years, probably the customer would have written it off also that this payable is not going to receive it.
That's a different issue, sir. So I'm just asking is, if a payable is outstanding and, you know, the customer is willing to pay it also, we are not talking about a write back or a write off here, but the customer is willing to pay it also, but needs maybe 4 years or 5 years to pay it, you know, from now. How will you classify it in the books? I mean, how do you see this payable which is against an import to categorically, or rather to directly get converted into a loan or a borrowing?
See, that again depends upon the conversation that you have with your customer, whether you want to treat it as a long-term borrowing in terms of how you want to make the payment. Is there a kind of a payment structure that has been decided, in terms of the repayment that you want to make, or is it something that the customer keeps asking for money? I also keep telling him orally or sending him a mail saying that we will pay it today, we'll pay it tomorrow. See, the moment I tell that I pay it today, I pay it tomorrow, it continues to remain only as a payable, because that guy is not demanding, he is demanding only his receivables in his books. Okay. But for me to treat it as an external commercial borrowing, there has to be an interest element into that. Whether this guy is going to pay an extra interest part of it, for the delay in payment, which is what they have agreed and they have signed in, that only determines the transaction, whether it is a ECB or whether it is a continues to remain as a credit. That's my view.
Got it. Anybody else who validates or rather who thinks that this view is correct, or thinks that 3 year is a period which is a long term in nature and therefore payable becomes an external commercial borrowing and needs to be reflected accordingly in the balance sheet, and accordingly has to be taken a loan registration number from the RBI and has to be done. I mean, whatever compliances are required to be followed under the ECB guidelines, we'll have to follow it after 3 years.
It's like deferred payment, so you may have to report.
You may have to report it as a ECB, okay. Anybody else around ECB versus a payable? And I mean, this is something I wanted to focus only and only because these are certain preset notions, these timelines, 3 years, 5 years, 10 years, which are not coming from anywhere in the law, please. 3 years is not coming anywhere in the law. Deemed ECB.
That is precisely I wanted to tell.
Yes. It can be in ECB for 1 year, sir. It can be in ECB for 1 year.
No, see, today my terms of payment with my customer is, let's say, 45-day credit period. 45-day credit period has gone over, deal done. Let's say probably has extended to another 15 days, 60 days. Then if you want to treat that as an ECB, then you treat it on the 60th day. No, why wait for the 3rd year to come and then say that I will treat it as an ECB? Some auditor comes and challenges it, saying that it is not. Then go through the RBI process. If RBI says that it has to be done this way, then it has to be done that way also.
Merely treating it as ECB will not make it ECB, sir.
Yes. So like
precisely what I'm saying.
Very interesting presentation, but I have a meeting to go
No problem, sir. No problem.
Nice meeting.
Very, sir. I would share my coordinates with you, sir.
Please, please.
Definitely. And take your coordinates as well. Definitely, sir.
Discuss FEMA with you.
Yes, absolutely, sir.
So, like he rightly said, and this is something which is, I would say, the heat of Foreign Exchange Management Act. There is no law or there is no regulation that mandates any period for a current account transaction to get converted into a capital account transaction. ECB is a capital account transaction. There is no regulation that says that post completion of 5 years, a current account will be deemed as a capital account. There is no concept of deeming fiction now in FEMA. And therefore, practically, if I share the cases that I've handled for my clients, I have about 10 to 15 cases that I've handled in the last 14 years, wherein I've had payables which have been outstanding for over 15 years that have been allowed to be paid back to the respective overseas entity without any compounding or penalty because they are current account transaction, still after 15 years. So what the point that I'm trying to make here is, and sir also got the point here, is that current account is a transaction which continues to be a current account unless and until it is proven to be a capital account. Whereas a capital account transaction continues to be a capital account transaction unless and until there is any deeming fiction involved. Current account transactions are all freely permitted transactions unless and until which are restricted under your current account transaction rules, like you said, like the Schedule 1, Schedule 2, Schedule 3. Capital account transactions are all restricted transactions unless and until specifically approved under the regulations. Now, why is it important to classify a transaction at the first go as current versus capital? I mean, any thoughts around that, and why am I saying that this is the basic of FEMA, thumb rule of FEMA, which needs to be understood before we deep dive into all these very what do I say, the complicated structures, ODI, FDI, round tripping, etc., etc. Why is it important to first understand what is current and what is capital account?
My guess is it's a
For
TCS
balance of
provision,
payments
no?
and other things.
Sorry?
Understanding balance of payments.
Okay.
My guess is that TCS deduction of 20% or whatever that is.
So that is on both current and capital. So that is applicable on both current and capital.
To control capital outflows.
Okay. Anybody else? Why this basic is being discussed and not the complicated issues? Yes?
There is no limit for current account transactions for non-individuals.
Yeah. So just to kind of correct, and rather I would say he's quite close there, is that whenever a client comes and whenever a client is facing a FEMA issue, what does a client typically ask for? Does this require an RBI approval? Or can this be processed under the automatic route? That's his first question. That's the first question your client will come and ask you. And how will you respond to that question? Unless and until you break down the transaction into current versus capital, you will not be able to revert to that client. See, the client does not want a confirmation on a piece of paper. They want your view. You're not asked to sign it on the piece of paper that this is a current account transaction or this is a capital account. But the way to give that value add to the client and get that client into your kitty is by giving your first view. That in your view or in your opinion, this is a current account transaction, and if it is a current account transaction, it can be very well processed under the automatic route and will not require an RBI approval, and therefore will not be subjected to that strain of 7-8 months of getting the matter approved from the RBI. If the client hears that from you, automatically it gives another level of happiness to the client, because nobody, I'm being part of Deloitte, I may not be able to share the kind of clients that we handle, but none of the client wants to approach RBI as on date, because they know the timeline involved, they know the complexity which is there. Like Sir had explained very well, it is a battle between the AD bankers and RBI. You need to first train out yourself to get the application rolling from the AD banker to the RBI, and once it reaches RBI after a good strain of 2 months of all the to and fro's from the AD bankers, I'm going through, I would say I'm going through 5 cases with Citibank, and I can tell you the hardship that I have to face. Because like Sir explained before my session, he was absolutely right. AD bankers are not technically sound as on date. Even for cases which are as simple as and can be processed within the powers of the AD, they wanted to route it to RBI. Why? Because hame apne pe kuch nahi lena. We don't want any risk on our head. We don't want tomorrow if RBI comes on a scrutiny and says, "Arey, ye transaction to hamare under aani chahiye thi, aapne kaise process kar di?" But that does not stop them to apply their own mind, and interpret the law which is required. So, as on date, all bankers will try to push your transaction that this transaction will require RBI approval come what may. But it is on the consultant to understand and to kind of give that comfort to the client, which will help you make, or rather which will be that value addition and help you make with the client, is by telling him, no sir, the nature is current account, and by the very law of Foreign Exchange Management Act, if it is current account, it can be handled by the AD bankers under the automatic route. There is a very important case that I'm handling right now, and it's come to a close after almost 1 year, and like I said, this was with Citibank. There were reimbursements, and reimbursements, like you all know, there were certain payments which were made by the parent entity, a US entity, on behalf of their India subsidiary, and this India subsidiary is a captive unit. And these are nothing but payables, which are coming in the books of the India entity towards their parent entity in the form of reimbursements. Because like you say, so there are, say for example, certain insurance coverage which is taken on a group basis. So the parent company paid the entire group charges, and then they, they had allocated the share of the subsidiary to the subsidiary's books, and therefore the subsidiary had certain portion as payable towards the parent company because it's a captive unit. Now, Citibank was of the view that because these are reimbursements which have been outstanding for more than 5 years, this will require an RBI approval. The first thing that I question Citibank is, where is this 5 years coming from? You show it to me in the law and then I will proceed on this matter. And that's where I started my, the presentation is, there are no timelines coming under any regulation. Of course, there are 9 months, 6 months coming in the, the period of realization. ECB has their own MA, MP, etc. But there are no timelines which have been prescribed by RBI which makes a current account into a capital account.
Ma'am, just one question,
Yeah.
one clarification. See, the insurance part that you are explaining, why should the Indian subsidiary pay to the parent company? What was the transaction there?
So the transaction was that this was a group charge which was paid by the parent company on behalf of all their group entities.
Okay.
Be it India group entity, be it the Mauritius group entity, be it Singapore group entity. And based on the number of employees, they had allocated the charge to the respective group companies. Because this was a payment which was made on behalf of the group.
Okay.
So the India captive unit had recognized a payable towards their parent company. So this is more like a reimbursement. Certain cost was paid by the overseas entity which is now required to be reimbursed back to the parent entity. The question here was, and the fight that we had to make with Citibank was, that reimbursements are current account in nature.
No, my question was, sorry
go ahead.
interrupting. See, the allocation has been made by the parent company for the monies that they have paid.
Yeah.
But why should the Indian subsidy pay back?
Because this is the cost to the Indian, this is the charge which is...
They would have charged it after the P&L, right?
No, correct. They would have charged, but this is a payable to the back to the, because this is a money that was paid on behalf of Indian company.
Okay, got it.
Yeah.
Okay, got it.
Yeah. And like I said, I had good 7-8 months of fight with the bank. That you let me know where is it coming in the law. The bank started to push me down. You let me know where is this coming in the law that this is not a capital account. Now clearly this is a non-trade current account transaction. There is no trade involved. There is no element of trade, import-export involved. But like I said, the extracts that I had shared with the AD banker to substantiate my position that this is a current account and therefore will remain a current account, be it 5 years down the line, be it 10 years down the line, be it 15 years down the line, is that there is no regulation by RBI in terms of any timeline prescribed for a non-trade current account transaction. And if there is no timeline prescribed, that means being the nature of being of course a current account in nature, it is very well under the powers of the banker. And as on date, the matter got processed under the powers of the banker. It did not require any approval from the RBI. It took me 7 months to prove the bank, but definitely those 7 months could have been utilized to either route it to RBI, but I know what the response would have come from RBI. Even after waiting for 7 months, the RBI would have responded back saying, this is a current account transaction and the powers are delegated to the AD banker. Therefore, we request AD banker to verify the required bona fide of the transaction and process it within their powers. This would have been the response of the RBI.
Is that your the bank has got no right to refuse the payment when it is above 180 days or above 360 days? They have to come forward to remit the money. Is it that you are advocating the argument?
Sir, I am advocating the argument that they cannot prescribe any timeline from their end if it is not in the law. They need to go by the nature of transaction. Had it been a capital account transaction, I would have definitely said yes, this requires an RBI approval, because a capital account transaction is a transaction which is regulated unless and until it is specifically provided for. Current account transactions are all freely repatriable. unless and until it is regulated by the current account transaction rules. This was my agenda, or rather this was my the stand which I was banking on.
You said it was a captive. Okay. When it comes to a captive, captive, there is already an MSA agreement which happens between the parent and the captive unit out there as to what are all the obligations which the parent company has to do and what the captive company has to do. So when it comes to insurance, obviously it takes care of the critical key resources within the organization for whom the coverage has to happen. So that itself is a sufficient proof for the these guys for the ADs to understand that it is a current account transaction, and why haven't they spent 1 year on to deliberating?
Sir, they were okay with the fact that this is current account, but because it was payable since the last 5 years, they had put this time frame. That because it's pending for 5 years, therefore we will give it to RBI for an approval.
So they
were not challenging the nature of the transaction. They were challenging the period for which this transaction was pending in the books of the Indian company. That was the challenge.
It's, see, the hedging comes into the play. See, once in 6 months, you are now exceeding the 6 months and 1 year and 2 years. Then see, why the ECB came into the picture, why the approval of bill of exchange above 360 days means just to go for approval limit.
Sir, I will give you an example here.
The reason behind that is the capital account convertibility. What we talk about is the liability or asset getting exchanged because of the exchange difference. See, what you pay. Let us say 65 was the dollar, now it is 85. So let us say the liability is there for the 20 years. The 20 rupees is nothing but a liability created in our books, and it has to be settled in somehow. So inverse interpretation, it automatically goes as that exchange difference goes as a capital account. So the banks are insisting for get the approval of RBI for extension of time from 180 days to 360 days or 360 days and above. It is a valid. It has to be imposed like that.
So, but unfortunately, that's not the position which is being accepted as on date.
Because of that, the bank is right in demanding. Otherwise, the Indian exchange will be in trouble.
Sir, Indian exchange hedging and all is a secondary picture right now. The former picture is that please do not subject the customers to the hardship. So please try and understand that when an auditor is auditing the books, all these are qualified by the auditors, or rather there is an EOM which is placed in the books. And merely because something can be done under the automatic route, but because due to lack of interpretation or lack of technical knowledge of the AD banker, this has been subjected to RBI approval, I mean the company's books will be, misreported. So my point here is that, like I said, that's the first thing that we typically try and understand, when we approach a client. We kind of tell them our view that why we feel that this can be done under automatic route. Second very important.
Sorry ma'am, just one question. In this particular transaction I am talking about, why did it take 5 years for them not to repatriate the money?
So there were some management issues. There were some people who left the company. They did not know what is the timeline. And they had all the documents to support. Not that there were documentation gaps.
No, why I asked you this question is, notwithstanding that so many issues would have been there within the organization, that is okay. But every month, the parent company pays the salary of the local captive guys out here. So when there is a money flow from the captive unit, from the parent here to the to the local captive unit for the employee salaries, etc., for whatever work that they do, there is a revenue there. It's not that they pay the salary directly; it is a revenue which has been agreed between the parent organization and the captive unit. For that particular project as to how many FT associates are going to be there and what is the revenue that is coming, basis with these people they pay the salary.
Correct.
So that means, in other words, that this transaction could have been settled. I mean, I don't want to get too deep into
you're
this.
right. It's just that maybe there were some technical issues. People were not aware of that. We have these payables towards the same parent entity. There were certain reporting issues. So I mean, I'm trying to say here is that if you have documents in place, If you have captured the documentation and there are no documentation gaps, you can definitely fight back and get your case done under automatic route.
Anyway, ma'am, I don't want to digress this.
Yes.
We will get back to
Sure. So, this is something which I thought is very critical. The second and the foremost part which I thought I will make here is that, like Sir had very clearly and categorically mentioned, if there is any component of interest involved in any payable, that is one factor which is considered, that the very nature of that transaction is not a payable but a loan. And practically, one of the most important declaration that is required to be given to the regulator, so for example, if you're making an application to the RBI or to the AD banker, that kindly give us an approval to remit these funds which have been outstanding for more than 20 years. The first and the foremost declaration that will be asked by the regulator is that there is no interest that has been levied on this payable. If you're able to give that confirmation, such approval or rather such processing will be easily done by the AD bankers, provided you have all the documents in place. So for example, you have the MSA in place, you have, say for example, director declarations. I'm saying that there are plethora of documents that are required to be given, but the most critical document that is asked typically by the regulator is from you to verify that there is no interest component involved, because if there is any interest component involved, it gives the nature of a loan, or rather a color of a loan to that particular transaction.
What if the interest is imposed by a statute like MSME? If the interest is imposed by a statute, what will happen then? We are not no interest between us. The statute says you have to pay interest. So payment.
Correct. So if it is something which is levied by a statute, definitely an exception can be drawn out for such cases. So for example, we have transfer pricing implications also which come into place. We have benchmarking analysis, etc. Now, in those benchmarking analysis, we are required to declare certain income, that this is something which is over and above. So for example, if you have a profit attribution, there are so many transfer pricing allocations that we have kind of processed or rather completed under the automatic. And by that, TP allocations, what I mean is, and if anybody here who works in transfer pricing would understand, is that, say for example, the profit attributable to the Indian company, or rather the cost attributable to the Indian company was say 90, but the Indian company has recognized 100 as the cost, and therefore the profit has gone down, and there is certain receivable from the parent company, or it could be a payable to the parent company due to these TP allocations. Now, whether these payables or receivable from the parent company will be processed under automatic route if it is pursuant to a TP allocation. Practically done. This is clearly under automatic route. There is no limit of any timeline. If you have the transfer pricing agreement in place, if you have the benchmark analysis in place, everything can be sorted under the automatic route. Earlier, the bankers were taking this view that any payable or receivable pursuant to a TP markup, change in TP markup will require an RBI approval. But in 2017, HSBC got this written clarification from the RBI, and I have the copy of that particular clarification with me, wherein RBI has asked HSBC to process it under the automatic route, because any addition or deletion pursuant to a TP markup is again a current account transaction. So like I said, everything revolves around the nature of the transaction. If you're sure that the nature of transaction is current account, you can fight it back. If there is any element of interest involved, a documentation gap involved, then definitely it will be under the capital account route and will require an approval of the RBI. So these are typically the current account key issues. I would want to go through these key issues because these are something which I deal in on a day in and day out basis. Now, what do you understand by set-off? There are regulations around set-off of import payable and export receivable, right? Under the directions. Earlier, it used to say it has to be towards the same party. That means the importer or the exporter has to be the same person. Now that particular regulation has been liberalized to include group companies as well. So I had a very practical case wherein we had certain, like this reimbursements case, we had certain payables and receivables from the same parent entity towards reimbursements. So by that, what I mean is that certain payments were made by the Indian subsidiary on behalf of the parent entity, and therefore it was a receivable in the books, and vice versa, wherein the parent entity had made certain payments on behalf of the Indian entity, and therefore there was certain payable in the books. Both payable and receivable were towards the same entity, which is the parent company. Can I set off that payable and receivable and kind of show it as a balance payment in my books? Is that possible, or is that will require an RBI approval?
See, if you're, this was precisely the doubt that came to my mind, which you raised up. But my understanding is that if you are able to knock off the payable and the receivable, which matches with each other, then we don't have a problem. But if there is something where there is a mismatch between the receivables and the payables because of certain other transactions which is getting knocked off, then you will have to, prove that this becomes a current account transaction, because the nature of the transaction or the genesis of the transaction becomes, should be classified only as a current.
Anybody else on this? Will the set off or a knock off of reimbursements require RBI approval, or can it be done under automatic route?
And again, how these transactions are looked at by auditors in their books when they are classified Schedule 6 of the balance sheet.
Auditors will classify this as a normal current account.
Then there shouldn't be a problem, because that is how you can't say that, because every transaction could have been a capital transfer also for some reason, which could have been, they could have accounted here, or if they are doing it maintaining a separate ledger folio for that, then it becomes more simpler.
Okay.
But it all depends upon how the auditors looked at each of the transactions and how they have classified it in the larger perspective. And if that becomes a current account, then it should be a current.
Anybody else? I would appreciate if some people, we just kind of have a dialogue around this. If you can share what you feel around why it should be under automatic route or why it should be under approval route.
Because reimbursement being current in nature, maybe
it can be automatic provided both the receivable and payable is below 365 days, or because beyond 365 days we need to get RBI approval for any other payable. So probably
beyond how many days?
365 days. If my export receivable is not realized within 365 days, I may have to get the RBI approval for delayed realization or for refund of my.
I will definitely come to that point after this.
Okay.
But this will require an RBI approval, even if it is a current account transaction, and I'll tell you the reason why. The law says that there should be a payable and receivable towards an export and import. Is this an export and import? This is merely a cross charge or an allocation to a group company. This is merely a payment that was made by the overseas entity on behalf of the Indian subsidiary, and therefore a cross charge in the books. Is there any element of import-export involved? Therefore, this will require an RBI approval. At least the net off is taken very seriously by RBI, and the reasons are well known to everybody. The initial liberalization was only made to goods. Now it's expanded to services. Now it's expanded to group companies. But if one leg involves goods and the other leg involves services, it will require an RBI approval. In our case, it's a cross charge. So definitely it will require an RBI approval. RBI did not want to open up the net off regulation for services was only because of the fact that there are no documents to substantiate the actual export-import of a service. For goods, yes, we have the EDF copy, we have the bill of entry, which can substantiate that the actual import and actual export has happened, and therefore this is a bona fide transaction which can be net off. Why do subject the Indian company to foreign exchange fluctuations every time there is a remittance made or a repatriation made? But now they have opened up this regulation to include services also. The reason being only and only because of the foreign exchange fluctuation. But that said, if there are any credit notes, debit notes involved, pursuant to reimbursements, if one leg has goods element but the other leg has service element, this will require an RBI approval.
So how does it impact? A lot of IT companies are there today, and many
Big time. Yeah, big time.
Big time.
We have a lot of cases which are going on practically, which have an element of which have elements of only reimbursements.
See, today, anyway, I can take it offline also because I don't want to digress the conversation that you are having. But many of the times when the MSA comes up for a renewal, or when the after the contract gets over, one of the points that get discussed is on the foreign exchange fluctuation by the customer, and he says if there is going to be an increase or a decrease in foreign exchange, to that extent our outflow also gets reduced. Then that becomes a point of negotiation.
Yeah.
So why should I agree for that? See, that is the place where I make my money also.
Correct. We'll discuss this offline.
Yeah.
I have deliberated on this issue before. Yeah. So these are key issues. I mean, if I have to go point by point, it will take me good 3 hours. But one of the key issues that I thought is something which is very routine and typically asked on a day-to-day basis from me by my audit team is around net off and set off. So this is something overview of foreign investment, automatic versus approval route. How does it qualify to be an FPI versus an FDI? Unlisted company, it's an FDI, irrespective. If it's a listed company, then anything less than 10% qualifies to be a portfolio investment. Anything more than 10% qualifies to be a FDI, along with the control element involved. Are you aware of the concept of FOCC, foreign owned and controlled companies? This is also very key in FEMA and FDI, foreign owned and controlled companies. So foreign owned and controlled companies are Indian companies in which FDI is more than 50 plus 1%. And therefore, the government deems it to be akin to a non-resident. If it is deemed akin to a non-resident, then all the reporting compliances, all the FDI norms or the regulations which are applicable or an Indian company receiving FDI becomes equally applicable where a foreign owned and controlled company makes a downstream investment or makes an investment into another Indian company. Now this is a very, I would say, very important aspect while reading FDI regulations. Our entire FDI regulations revolve around FOCC. See, if we have a non-resident entity investing into an Indian company, it's an FDI. If it's FDI, we are subject to FDI guidelines. Everybody would know that. But the most important aspect in the FDI regulations is FOCC, foreign owned and controlled companies. Because typically we have shared transfers between FOCC, we have whether FOCC undertaking a share swap will be subject to an RBI approval. We have all these cases which come. Can anybody help me understand if an FOCC gives a loan to an Indian company, and here we are saying that FOCC is seen akin to a non-resident, and therefore if an FOCC makes an investment into an Indian company, that investment will be subject to FDI guidelines, all FDI guidelines, reporting, sectoral caps, valuation, etc. But if an FOCC gives a loan to an Indian company, will that be seen akin to an ECB? Any thoughts around that? If you want, I can repeat it once more, because this is something that we also struggled for a number of years when we were asked by this question from our clients to confirm if a loan given by an FOCC to an Indian company will qualify to be an external commercial borrowing, and if it qualifies to be an external commercial borrowing, we'll have to take the LRN number and do the regulatory compliances around that piece.
No foreign currency involved.
So it's a domestic loan. Any other then why do we say that an FOCC making an investment in an Indian company is akin to an FDI? Even there is no foreign currency involved. That's also domestic investment.
That is
repatriable, no? That is maybe that is.
No,
Maybe that.
both are repatriable. See, that's why I started my presentation by saying it's very easy for us to go through the regulations. 9 months, 6 months, net off, extra, compounding rules, 15 days, 1 month. But all these are practical nuances, wherein we need to really understand the harmonious thinking between the RBI being the regulator for cross-border transactions and DPIIT being the regulator for FDI. Now, for the longest time, we try to understand this and try to debate it with both the regulators, because there is an interplay between two regulators involved. One is RBI and one is DPIIT. DPIIT is a regulator that monitors all the foreign direct investments. And loan is something which is monitored by the Reserve Bank of India if it's a cross-border loan. Now, RBI very categorically said that I do not recognize the concept of FOCC under FEMA. If you read the definitions under Foreign Exchange Management Act, you will not get any definition of foreign owned and controlled company. Where is this definition coming? This definition coming is under FDI. Where is FDI coming? FDI comes as part of your section 6 of FEMA as a capital account transaction, because it's an investment. But RBI very categorically says that there is no concept of foreign owned and controlled company under FEMA, and I will not adopt that concept even if that concept is being adopted by another regulator. And therefore, like you said, sir, that there is no foreign exchange involved. That is the viewpoint that we also took. Not because there is no foreign exchange involved, because the concept of foreign owned and controlled company is not recognized by the Reserve Bank of India under Foreign Exchange Management Act. And by that, what I mean here is that if a loan is given by a foreign owned and controlled company to another Indian company, it's a domestic loan, will not require any compliance with external commercial borrowing guidelines. But if an investment is being made by a foreign owned and controlled company into another Indian company, see, FOCC is an Indian company only as per Companies Act. It is just that because it has an investment from a non-resident which is over and above 50%, thereby the non-resident is owning and controlling the management of this Indian company. That Indian company is being seen akin to a non-resident, but it is Indian company by its very essence.
What happens when the remittance goes outside when he wants to pull back his investment?
So pull back by way of share transfer, how? How pull back the investment?
He sells off. He values the company and he sells it off.
So just like any other reporting which is required for your FCTRS, your valuation will get equally triggered.
Yeah, but
so by that what I mean here is that an FOCC has made an investment in an Indian company, and that FOCC is transferring those shares of an Indian company to say a non-resident, an actual non-resident, then you will be required to file Form FCTRS. That's what I said, that even if the investment is in INR, but you're being made subject to all the guidelines which are applicable for a non-resident making an investment in India.
But he sells it to a resident, then what happens?
If he sells it to a resident, then also you will require to file Form FCTRS, because it will be seen as a resident to NR. Yes.
So because at the end of the day, the capital outflow will happen because he has to take back his money once.
Yeah. Any other question around this, what we discussed, FDI, FEMA? See, I know these are it's been 14 years, we still struggle. And like sir said, we have to struggle with regulators, with their interpretation, with our interpretation. But at the end of it, it boils down to practical case studies, practical laws, practically handling clients. And how do you win clients is by having your own viewpoint around FEMA. So these are typically the key issues around FDI. I'm sure you would know that any kind of FDI coming from China or neighboring countries requires an approval. That approval is now being sought from MHA. So far, we've not got any approval for an FDI coming in from China. Of course, we've had cases wherein the investor was an Indian citizen, or rather is an OCI card holder. It's only then that we've got an exemption from the government and we've got an approval for an investment coming in from a Hong Kong citizen. Because that Hong Kong national, I would say, holds an OCI card. These are some case studies around downstream investments. Now ODI, like Sir was explaining ODI. This is one area which again I feel is very practical in nature. It depends upon case to case. We have plethora of cases wherein promoters have made ODI structures, but those structures are non-compliant and we are asked to regularize those non-compliances. Any idea around round-trip structures? Anybody who's worked around round-trip structures? I think I'll put my last 15 minutes around ODI because it's very close to me, it's very close to my heart because I work a lot around ODI approvals and ODI guidelines. So I'm keeping it very short and simple, knowing that this is the last session. I'll keep the last 15 minutes only for ODI. Round-trip structures, anybody, how it started, how it began, how it came under the radar of RBI, how it now becomes a part of your API reportings. It was never a part of API reporting earlier. Why RBI got round-trip structures? Anybody round-trip? What does round-trip mean?
Associated shell companies are one.
What does round-tripping mean? Round-trip.
Recycling.
Recycling
is the same.
And why does that happen? Who started these structures?
Share capital, then reinvestment.
Illicit funds to reroute illicit funds to legal funds. How to be
rotating funds. So, of course, Mr. Malia, these structures were set up by him. And why these structures were set up? So, for example, I have an Indian I want to avail a loan in India, but my credentials do not really match up with the banking, I would say the records. What do? I set up a company overseas and I take loan at my subsidiary level overseas. And then I pump up the same money that I've taken overseas back into India. I have very well cheated the law. I was funding deprived. I got funding through my own company by taking a loan overseas. That's called round tripping. And that is why RBI, when they got these structures, they immediately brought ODI FDI structures. These are called ODI FDI structures. ODI FDI structures means an ICO setting up a company in Singapore, Singapore company setting up back a company in India. ODI for ICO, FDI for Singapore company. ODI FDI structures. Round tripping, ODI FDI structures. We do a lot of structuring assignments for promoters, for hedge funds, etc., wherein we try and understand why this structure was set up. See, we cannot blindly go by the law by saying that if it is an ODI FDI, it will require an RBI approval. We need to understand what is the nature of money which has been pumped back into India. Now, what does ODI guidelines say? ODI guidelines say that you are allowed to make investment overseas under automatic route for a bona fide business. There is a term called bona fide business being used in the ODI regulations. If I merely pump back funds into India, is that a bona fide business? And that is exactly why RBI wanted approval or rather was not even approving such cases back then. Now it's under automatic route, which I would say in the next 4 months will again come back into approval route. Because it was defeating the law, it was defeating Section 6 of ODI, Regulation 6 of ODI, master directions that time. One of the important aspect of qualifying an ODI under automatic route was to ensure that the investment is made for a bona fide business. This is clearly not a bona fide business. But if I can support my investment back into India by saying that this is being made out of my accumulated profits from a bona fide business outside India, I do not see a challenge there. I mean, investing back into India to explore a business opportunity, to maybe expand back into India, to maybe acquire, something wherein they feel that this particular sector will be booming, out of my profits which I've earned overseas, is not round trip.
But there will be a timing difference also, right?
Timing difference, by that I mean?
For example, today I do a ODI, okay? And take the case of Vijay Mallya. I'm just trying to, think a bit aloud. Today I'm, doing a ODI, and after, let's say, 3 years or 4 years, I'm doing an FDI there, and then bringing the money back into India. So there is a timing difference here. Okay, it has not happened simultaneously where I do a ODI and then an FDI, which you can call it as a round trip transaction. So in that case, how does it?
Sir, like I said, timing is never a concern. The only concern in current and capital account is the nature of money. What is the color of funds that you've got it back? If you're able to segregate, and of course, sir, see, cash is fungible. You cannot segregate cash by saying this is a white cash and this is a black cash. But that's why I said you need to get into the genesis. We had to cull out the balance sheets. We had to cull out the bank statements of that particular client to understand where are these funds coming from. What is the source of funds? If you're able to substantiate the source of funds, you can very well say that this is not a round trip and therefore the client is not subjected to any penalty. I remember the maximum penalty RBI has ever imposed out of all the compounding orders that you see on the RBI website is on an ODI FDI structure. Because that is truly a non-compliance vis-a-vis a non-filing of an FCGP, a non-reporting of an FLA or a non-reporting of your FCs. That is truly defeating the law, that is truly circulating the money which is against the genesis of FEMA or the objective of FEMA. So we had to get into that detailing of the sourcing of funds to substantiate or to prove it to the regulator that the funds that are being invested back into India are bona fide funds, are out of the profits that the company has earned overseas through a bona fide business and cannot be seen as a round trip. And that's when I think RBI also had plethora of cases. They brought round trip structures under automatic route. That said, the reportings which are applicable for a round trip structure are still there. There are specific clauses which are added in APR to say if you have any subsidiaries in India, please highlight. Because RBI still wants to keep a track or radar of any or every kind of structures which have any kind of ODI FDI element or leg involved in it. Under the new ODI FDI guidelines, yeah.
Trip, right?
Sorry?
Vijay Mallya's was not a round trip.
No, sir. It was.
It was, no?
Yeah.
Okay. So, but he didn't get money in India.
He did.
So, he then pumped it back.
Yes.
And then
and typically, when that time we had gone to seek post facto approval from the RBI, and post facto approval is, when we had gone to RBI to seek regularization of this non-compliance of round tripping, RBI very clearly had mentioned in their letter that either you unwind these structures, there is no option left but to unwind these structures. It was not that RBI was approving those structures. They wanted you to transfer or unwind the India leg and make it a clear ODI leg.
So you are not able to use that money at all?
Yeah. They wanted to unwind the India leg. Only then the regularization was being done by RBI. Moving on, I mean, this is something which I thought is very critical in terms of your understanding, because structuring is, I feel, I mean, is something which is very good in terms of, you know, the clientele that you can get, the money that you can ask, because structuring is where the real money is. And that is where, you know, we do as consultants. We have a certain, you know, kind of liberalizations which were brought in under the new OI guidelines, and these guidelines had, for the first time, liberalized the ODI FDI structures to say that you can have two level of downstream companies. That said, RBI has yet not liberalized the ODI FDI structures for promoters, wherein individuals have set up a foreign company and that foreign company has set up, or rather routed funds back into India. That is again not permitted, and by not permitted, it is not even that RBI will approve or give approval for those cases. They are absolutely prohibited. So if you have any promoters who are wanting your viewpoint in terms of any kind of investment being made or has been made earlier which has any India leg involved, please highlight that to the promoters. Because we have seen a lot of promoter structuring involved, you know, wherein, you know, they have these, I would say, pre-2014 setups, you know, where they're saying that prior to 2014, you know, individuals were allowed to have these kind of structures. There are no law or regulation around that. Yes, if it's an OPI, I agree. And by OPI I mean is what, and I'm sure that, you know, you would have gone through the regulations. There is now a very clear distinction between ODI and OPI in the ODI guidelines as well. If it's a portfolio investment, clearly any structure is allowed if it is a portfolio investment. But to substantiate that it's a portfolio and not an ODI rests with the consultant. And how do we substantiate that it's a portfolio investment, not an ODI investment? Is by very nature of the capping of 10% and of course the control element involved. See, I being a promoter cannot contest my investment to be a portfolio investment. Can I do that? I have majority shareholding. Even if I say that my shareholding is 3%, but me being the promoter, how can you say that I do not control my own entity? And how do you substantiate control? Is through the control agreements, the voting agreements that you have in place. Who has the veto power? Who takes majority of the decisions? Who has the right to inspect the books? You know, all these clauses which are built in at the time of, you know, incorporating a company are extremely important in understanding who actually controls the company. So I had a very practical case very recently that I handled wherein, and I cannot name the company, but the promoter said that I do not control the company. And he had the veto right. He could, you know, turn down any decision that was being taken at the board meeting. And therefore, I mean, typically, you know, these structures which are promoter driven are all ODIs. I mean, I've not seen any OPI structure till date. Yes. So anybody, now that it's time to conclude, and I can see this was quite a heavy session which I did not intend to, but my only intention of having this session was to give you all the practical case laws and not just, let you know that compounding rules, compounding regulations, import 6 months, export 9 months. No, I mean, I'll share my coordinates with you. I'm always available to answer your questions if it has any, if you feel that you need to consult around FEMA, and I'll be happy to share and assist anytime. Okay, sure. Yeah. Thank you.